Yes, Thofik sir, we are streaming live.
Okay. So is my voice audible? Just a check. Is it proper?
Yeah, it sounds good. Just your video is not visible.
Hmm, just a minute. Is it visible now?
Yes, it's visible now.
Okay.
Yeah.
Okay, fine. So we'll start. So welcome to day 2 of this revision. And yesterday we have completed the topics. We started with leverages and then we also started with investment decisions. So after that we completed cost of capital and then we started with capital structure decisions. So investment decisions, I said that some part of investment decisions we are going to cover today, and then we'll be seeing few more issues in cost of capital, and then we'll be continuing capital structure decisions. So first, my agenda is that first I'll do this capital structure decision because that is completely computational chapter and very easy chapter to handle and tackle all the problems. So we'll start with capital structure decisions first. Okay. Okay, fine. So I just check the YouTube if it's live. So fine. So you can just comment a hi so that I'll get to know that yes, people are there and watching me. Fine. So let me start with capital structure decisions. Capital structure decisions means the decision regarding what should be my capital structure, which means regarding the liability side of the balance sheet. So let me just give you an overview. Now, if this is my balance sheet, so this is my balance sheet, this liability side and this asset side. So liability side is known as sources of funds. So I can source my fund from different sources. So it can through equity share capital, through retained earnings, through preference share capital, through debentures, through loan. Now I'm sourcing 100 crore rupees. So I will be, taking this example a lot of time because end of the day, it is all about, the only difference between accounting and financial management is all about accounting is like a postmortem. When everything is done and dusted, then we will be checking our accounts, seeing what are all the, what is the health of the company. Financial management talks about today we are considering and today we are taking decisions about the future because decisions cannot be taken for past. Okay, decisions should be taken for future. So financial management is a future oriented subject. Accounting is something what has happened in the past and then we are checking. So that is that is the core difference between accounts and finance. So now, when I'm having the liability side, which is containing the source of funds, suppose I'm financed 100 crore rupees and that 100 crore rupees I've invested here. Now this 100 crore rupees, every business, okay, every organization is just a portfolio of business or portfolio of projects. So suppose I'm having project A, project B, project invested in these projects and each project will be having different set of assets. So you can just take it as different business divisions. Now, in which project I should invest, which project I should not invest, all these are taken in investment decisions. All this we have discussed in investment decisions. Basis a lot of techniques we have discussed. So, based on payback period, we will be selecting the project, or based on discounted payback period, based on NPV, based on IRR, based on profitability index, we will be ranking the projects for investment, or either choosing the project whether I should accept it or whether I should reject it, or even if I should I purchase this machinery or should I purchase that machinery. All these are investment decisions that we have already discussed. Investment decision basis techniques. One or two problems I'm going to do, provided if we get some time. So because our main focus is to cover a lot of areas, so we'll see if we'll be able to do a problem solve. Now, in the liability side of the balance sheet, I have financed 100 crore rupees. Now, as I already said, every capital will be having some cost. That is what is called as cost of capital, specific cost of capital. Suppose I'm having an equity share capital, the cost of equity is 20%. The cost of retained earnings is 15%. Cost of preferred shares is 12%. Say debentures is 10%. Say loan is 11%. So, okay. So all these are my cost: KE, KR, KP, KD, and KL. So how to calculate the specific cost of capital? This is something that we discussed yesterday. Okay. Now this 100 crore rupees that I have financed, this 100 crore rupees can be, okay, it cannot be 100% equity. We are having a combination of all these capitals. So that is the reason the weighted average cost of capital, the specific cost of capital is to find out the specific costs for equity, specific cost for retained earnings, and then we will allocate the specific cost for our weight of the capital to find out something called as KO, which is what is called as weighted average cost of capital. That talks me for this entire capital of 100 crore rupees, what is the cost. Okay. Now, this 100 crore rupees where I'm investing, for this investment, I will be getting something called as project return. That is what is called as IRR. So if my IRR is more and if my KO is less, my PNL will show a positive balance. Like approximately, I'm just telling my NPV will be positive. My NPV will be positive. Basis, I will be having some surplus. So I am having some profits. Actually, profit is not directly linked with IRR, but I'm just for a structural visualization purpose, I'm just wanted to show you. If your KO is less, which means you're taking money at 15% rate and you're investing money at 20% rate, so you'll be getting some excess amount of 5%. That 5% can be the return which will be sitting in our PNL. And for this amount, should I retain or should I again reinvest into the business? That is the third decision, which is dividend decision, that we are going to discuss in the following. Okay, so with this introduction, what we discussed yesterday was how to calculate this KO. So basis this KO, I will be discounting this KO to take decision whether I should accept or reject. Okay. Now, this 100 crore rupees can be 50 crore rupees equity, 10 crore rupees retained earnings, 10 crore rupees preference share capital. Okay, say 20 crore rupees I'm having debentures and 10 crore rupees I'm having loan. Okay, suppose this is the structure. Now, the next decision what I should take is that how much equity should I be having? How much retained earnings should I be having? How much preference share capital should I be having? How much debenture should I be having? Or how much loan should I be having? So that what should be my optimum capital structure? That is the next question. Now you all would be thinking this way, sir. The lowest is cost of debt. Okay, the lowest is cost of debt. So take 100% cost of debt, sir. Why you want to take equity? Why you want to take retained earnings? Take 100% cost of debt. So 100% will be the weightage. 100 crore rupees will be the cost of debt. My overall cost of capital will be 10%, sir, and 10% is the lowest cost of capital, sir. So that is what is called is the ideal capital structure. This is what you would be thinking. But now I will give you a counter argument here is that if you take 100% debt, which means your debt equity ratio, you don't have any equity, you have 100% debt. If you're having 100% debt, you have to pay interest on that 100% debt. Okay, sir, when you have to pay 100% interest, 100% the interest you have to pay on 100% debt, that means your interest will be high. If your interest is high, your financial leverage is high. And I already said you that financial leverage is the risk. The higher the financial leverage, the riskier the company is. Okay, sir. So which means 100% debt is not feasible. Okay. So take zero. Okay, take zero financial leverage, sir. Don't even take debt. Take 100% equity, sir. If I'm taking 100% equity, my cost of capital is increasing to 20%, sir. So because my cost of capital is increasing to 20%, maybe I would not be getting sufficient investment, sir. Because maybe in investment I would be having 15%, 16%, 80%, and then I'm having my cost of equity as 20%, which means there should be some balance should be struck between this. Okay, and that balance, how we are going to see is that we are going to see an EBIT EPS or MPS analysis. So on the basis of this analysis, we are going to have a capital structure. So that is what is the discussion that we have made yesterday. We have started that discussion. Now, what is this EBIT, EPS, and MPS analysis? Okay, so in-depth discussion I've made in one YouTube video, which is there in my YouTube channel that you can watch it. But now I'm just giving you a small overview. So if I'm investing in a project, I will be getting something called as EBIT. From EBIT, I will be reducing interest. I will be reducing taxes. Then I will get profit after taxes. Then I will be reducing preference dividend. So I will be getting equity available to equity shareholders. Then I will divide number of equity shares. I will be getting EPS. Wherever the EPS is maximum, that is the best capital structure. Okay, sir. So till EPS, I know wherever EPS is maximum, that is the ideal capital structure. That is one. Sir, how to find out the price, sir? Now, I know my EPS, but how to find out my price, sir? See, for this, you should know one important ratio, which is called as P ratio. Now, P ratio means price earning ratio. Okay. What is price earning ratio? Price earning ratio na price divided by earning. Price na market price per share. Earnings na earnings per share. So this is what is P ratio. Okay, this is what is P ratio. Now, see, formulating this P ratio is easy, but understanding this P ratio is what requires some deal of intelligence. And now, what is P ratio actually means? It is very important ratio which is even used practically. So practically, whenever you see any interviews where stock analysts are speaking something about the stock recommendation or industry recommendation, they usually mention this word P ratio. So P ratio means what? The P ratio means how much my shareholder is ready to pay for this level of earnings. That is what is P ratio. Now, for example, I'm having company A and then I'm having company B. Okay. So company A say it is a listed company. Company B say it is an unlisted company. So for listed company, finding market price per share is very easy. Say both are same business. Okay. Both are similar company operating in a same business environment. Okay. Same business environment, same leverage, same risk, everything is same. Both the companies are identical in all aspects. Okay. Now, company A, because it is a big company, it is a listed company, it is having EPS of 100%. Okay. And this is having an EPS of 5%. Because EPS we can calculate very easily. EPS is nothing but profit after tax divided by number of equity shares, or earnings available to equity shareholders divided by number of shares. That is what is EPS. Now, because this is listed, I know my market price per share. So this share is trading at 1,000 rupees. Okay, this share is trading at 1,000 rupees. Now the question is, how will I find out the market share for this? Because it is not trading in market, so it is very difficult to find out the market price per share of an unlisted company. Point number one. So this is the issue. Now I'm just trying to explain you P ratio. This is just one effort to explain P ratio. Now, what you have to understand here is that my shareholders are ready to pay 10 times the earnings for this share. Okay, which means if my earning is 100 rupees, my shareholder are ready to pay 10 times the earnings. So my shareholder are ready to pay 10 times the earnings. So that is what is called as P ratio. P ratio is 10 times. Which means for this particular company, okay, for this particular risk, for this particular business, my shareholders are ready to pay 10 times. So since both the companies are identical in all aspects, both are working in the same industry, both are having the same risk class, equity shareholder will also be ready to pay 10 times here also. So if they are taking 10 times here, 10 times here also. So which means 5 into 10, so 50 rupee will be the price. Okay, 50 rupee will be the price. So this is one effort to find out the price. So which means, sir, if I want to value any share, P ratio is one of the measures. So what we have to do, we have to take some surrogate P rate. For example, this is in the same industry. So in the real life, if you see two companies of different sizes and both are operating in the same industry, both are having the same risk, then you have to find out, you have to just compare the P ratio. Using the P ratio, we will be identifying whether one company is overvalued or one company is undervalued basis the P ratio valuation. So for example, the industry P ratio is 10 times. Industry P ratio is 10 times. So this should be valued at 1,000 rupees. But right now, the market price per share is 800 rupees. Which means it is undervalued. So it is undervalued, you will purchase. It is overvalued, you will sell. So that is what is the concept of P ratio. So now I think you understood what is P ratio. So that is the reason I say P ratio is equal to NPS divided by EPS. P ratio means what the investor, how many times of the earnings are investor are ready to pay as the market, okay, as the value per share. So how the shareholder is valuing the share? It is on the basis of number of times of earnings. Okay, sir. So which means from EPS I can derive the MPS. Yes, from EPS you can arrive the MPS. Now, yesterday we have discussed the capital structure decision. You will be having different options. So option 1, option 2 and option 3. So which means for different, you will be having EBIT. Okay, this is your profit. And these options are just changing the capital structure. Everyone is changing. Say here the capital structure is debt equity, debt equity, debt equity. Here my debt equity is 50-50. Okay, here my debt equity is 40-60. Here my debt equity is 80-20. Now, because it is 50-50, okay, here my interest will be, okay, here my interest will be this amount, okay, suppose 50. So here my interest will be on the basis of 50% debt. Here my interest will be on the basis of 40% debt. Here my interest will be on the basis of 80% debt, which means here my interest will be high. Here my interest will be low. Here my interest will be moderate. So here my financial leverage will be high. Here my financial leverage will be low. You just connect all these topics. So once I do EBIT minus interest, I will be getting profit before taxes. Now I have to reduce taxes here. I will be getting profit after taxes. Suppose I'm not having any preference dividend. So here I'm having preference dividend also. Preference dividend 10 and this equity is becoming 50. So now if I'm having my preference dividend 10%, so which means here I will be having preference dividend. Okay, here no preference dividend, here no preference dividend, but here I will be having some preference dividend, and this will be earnings available to equity shareholders. So on this earnings available to equity shareholders, I have to reduce something called as number of equity shares. So number of equity shares will be different for all these three, because here the equity is 50%, here the equity is 50, here the equity is 20%. So you just have to write the respective equity, and then this will be your EPS. Now, sir, on this EPS, what you do, you multiply PE ratio. You are going to get something called as MPS. Wherever the MPS is higher, okay, well, that is the option that you have to choose. So this is what is called as capital structure decision, EBIT, EPS, and MPS analysis. Okay, EBIT, EPS, and MPS analysis. Okay, sir, I understood, sir. Which means from EBIT, I should calculate EPS. From EPS, if I multiply P ratio, I'm going to get MPS, and wherever the MPS is higher, that is what I have to choose. So if P ratio is not given, just go till an EPS. Wherever the EPS is higher, choose that one. Okay, sir. Till this I understood. Sir, what if P ratio is not given, sir? K is given. Okay, suppose K is 20%, it is given, sir. Now, I already said that we have four formulas for K. Okay, just a revision, four formulas for K. First is constant dividend approach. Constant dividend approach, okay, D by P0. Constant earnings approach, EPS divided by MPS. And dividend growth model, D1 divided by PO plus G. And then capital asset pricing model, risk-free rate plus beta into RM minus RF. Okay, I'm not going speed. All these are already discussed. I'm just revising it now. Now, if you see this formula and P ratio formula are actually related. So P ratio is MPS divided by EPS. Okay, and K is equal to EPS divided by MPS. So both are inverse to each other. So I can say that K is equal to 1 by P ratio, or P ratio is equal to 1 divided by K. Okay, so அப்படின்னா P ratio கொடுக்கலன்னா நான் K வச்சுட்டு I can find out the P ratio, which means if I am having my K is equal to 20%, my P ratio is equal to 1 divided by 20%. So if you do 1 divided by 20%, you will get your P ratio is equal to 5 times. Then if you multiply the P ratio with EPS, you will get your MPS, and then the maximum MPS you have to choose. Okay, so all the issues what all I'm discussing. Okay. Now let us just see one small problem so that you get some clarity for capital structure decisions. So this is one of the easy problem I want you to do. Okay, I'll be doing one big problem. I mean, I was just showing how to solve a big problem, solve this problem. This you do it as homework, a very easy problem. Okay. Let me do this problem. Okay, let me do illustration number. I mean, I'll not be doing it fully. I'll be just showing you how to do it because it is very easy problem. The best of like a profit making company having a paid up share capital of 100 lakh consisting of 10 lakh ordinary shares. So already they are having 10 lakh shares. Okay, already they are having 10 lakh shares, and now they want to have one new issue of shares. So your number of equity shares will be 10 lakh plus what is the new issue. That is something that you have to remember in your mind. So existing equity is 10 lakh shares. Currently it is earning 60 lakh rupees. Okay, currently it is earning 60 lakh rupees, and it is listed and it is quoted at the range of 50 to 80. It is quoted, sir. So market price is quoted for 50 to 80. The management wants to diversify production and has an approved project. So which means approved project. So some new investment is there for 50 lakh rupees, which will give you 40 lakh rupees per annum. So already you're earning 60 lakh rupees. This project will give you 40 lakh rupees per annum. So your total EBIT will be 100 lakh rupees. Okay, your total EBIT will be 100 lakh rupees. To raise this additional capital, following options are there, which means this 50 lakh following options I can raise. First one is totally you raise it for equity, and that equity it is expected to that the new shares face value 10 and can be sold at a premium 15. So new shares are issued at 25 rupees. Okay, because face value 10 and premium 15, so they're issuing at 25 rupees. Many people do a mistake here by just doing the divided by 15. They're thinking that 15 is the issue price, 15 is not the issue price, 15 is the premium price. Many people do a mistake here. Around 80% students do a mistake here, so never do this mistake. So face value 10 sold at a premium of 15. What is the second option, sir? Second option, non-convertible debentures you issue for 100 rupees. Okay, so non-convertible debentures are totally debt. So which means first is 50 lakh total equity. Second is 50 lakh total debt. Third one, to issue equity share capital for 25 lakh, face value 10. Okay, face value 10. So which means for 25 lakh I want to issue. So 25 lakh I want to issue equity. Other 25 lakh I want to issue debt. That is what I'm telling. So to issue equity share capital for 25 lakhs and 16% debentures for the balance amount. So 25 lakh equity, 25 lakh debt. In this case, the company can issue shares at a premium of 40 each. So which means here the issue price is 50 rupees. Okay, here the issue price is 50 rupees. What is the significance of issue price? The significance of issue price is that if the issue price is 25, the number of shares will be basis 25. The issue price is 50, now the number of shares will be less. So here the number of shares will be more. So here 50 lakh divided by 25. Here 25 lakh divided by 50. So this is what is the difference. Okay, so now this I got. So first what you have to do, just directly write EBIT. Okay, directly write EBIT. Profit before. So existing I'm earning 60, new I'm earning 40. So 100 lakh rupees is my EBIT. Okay, 100 lakh rupees is my EBIT. I'm having three options. First option 100 lakh rupees. I mean the new project, right? 50 lakh rupees debt. Second will be, first is 50 lakh rupees equity. Okay, that is what is the first option. So you have to write in the heading. Okay, issue only equity shares. Option 2, issue only debentures. Option 2, 15% debentures, 15% equity. So this is for 50 lakh equity. This is for 50 lakh debt. This is 25 lakh equity, 25 lakh debt. Okay, so that is what are the three options. So because here 50 lakh rupees equity and I'm having only equity, so I'm having no debentures here. Okay, so that is the reason no debt here. Here 50 lakh into 16% is the debt. Here 25 lakh into 16% is the debt. So EBIT minus interest is equal to profit before tax. Tax rate is equal to 50%. It is given in the question. Tax rate is equal to 50%. So when my tax rate is equal to 15%, I will be having profit after taxes now. Now I'm having my profit after taxes. Now this is my profit after taxes, and I am not having any preference dividend. So this is what is the earnings available to equity shareholders. So earnings available to equity shareholders divided by number of shares. So how will I find out the number of shares? See, existing how many shares they're having? Existing they're having some 10 lakh shares, correct? So just write existing 10 lakh shares. Okay, existing 10 lakh shares. Now, how much is the new issue? In the first case, 50 lakh is the new issue issued at 25. So 2 lakh is the new issue. So total, I am having 12 lakh shares. Here, no equity is issued, so I'm having only 10 lakh shares. Here, 25 lakh for equity, but it is issued at 50 rupees, so only 50,000 equity shares, so 10 lakh 50,000. So these are my number of equity shares. So earnings available to equity shares divided by number of equity shares will give my EPS. So this profit divided by 12, 10, 10, 50, you are going to get EPS. Now see where my EPS is maximum. Your EPS is maximum for the second case. But because your EPS is maximum for the second case, choose option 2. See, it's so simple problem it is, but let me do practice side problem. Okay, now silly mistakes are possible here and there. So this is EBIT, EPS, and MPS analysis. Here, debt can be through slab rate. See, here, debt is given like a slab rate. Sometimes, debt is given like a slab rate. Here's the calculation of debt is on a slab rate basis, which means till 2,50,000, this will be my interest. Till 10 lakh, this should be my interest. Till 50 lakh, this should be my interest. So interest is increasing at an increasing rate. So 10, 15, and 20. So this is how you have to calculate. So interest will be having one working note here. Okay, number of equity shares will be having one working note here. And then you have to do this option. So that is how you have to solve the problem. So this is like a very simple problems, EBIT, EPS, and MPS analysis. So hence we are closing this EBIT, EPS, and MPS analysis. Okay. Now let us start with a new topic which is called as indifference point. What is indifference point, sir? Indifference point is the EPS level. Okay, it is the EPS level at which it is the EPS level. No, 1 minute. An indifference point, which means between two options, the EPS level is same. So EPS level at which both the options are indifferent. Which means, see, previously you were calculating EPS, correct? Previously, for those three options, for example, you're having option A, you're having option B. What you are doing, you are calculating EPS for both these options. So what I'm telling here is that how much should be, okay, but how much should be my, like at what point, okay, but at what level you will choose both A and B, like at what EPS level both A and B both will be indifferent. But because the EPS is higher in A, you are selecting that, okay. So once you're lowering your debt, what will happen? Your EPS will reducing. So your EPS. So EBIT means what should, sorry, EBIT level, okay, EBIT level at which your EPS is really sorry. So EBIT level. EBIT level at which both the options are indifferent, which means at which the EPS is same. EPS is same. Now you are starting with EBIT, okay, and you will ending at EPS. Wherever the EPS is maximum, that is the option that you will be choosing. This is what we learned. Now what will happen here is that if your EBIT is increasing, also change, correct? That is what we saw in leverage also, in financial leverage. How much you're changing EBIT, so that much your EPS will change because of the leverage. So capital structure is changing, the leverage is changing. Leverage is changing, this percentage change will change. So what they are telling is that what should be my EBIT at which the EPS is safe for both? What should be my EBIT, which means how much minimum I should earn. So option A is more attractive. So lesser than that, option A is attractive. More than that, option B is attractive. That is what they are trying to tell. Okay, so which means what I should do here is that I should find out this EBIT level. It is what is the next discussion. So which means how I should find out. So option A and option B. So I am having EBIT. Okay. Now I don't know the EBIT. So I'm just keeping it as EBIT here. Okay, I'm just keeping it as EBIT. And this should be the same. Okay. This should be the EBIT level, which is same for both, which is having same EPS. The EBIT minus interest. Interest will be different. Okay. So minus I1 minus I2. Interest will be different. So this is EBIT minus I1. This is EBIT minus I2. Okay. Then what you're going to do, you will be reducing taxes here. So once you will be reducing taxes, what you will get? You will get profit after taxes. Profit after taxes, the EBIT minus I1 into 1 minus T. Correct. That is what is profit after taxes. Here EBIT minus I2 into 1 minus D. This is what is profit after taxes. Suppose you're having any preference dividend, okay, minus preference dividend that you're going to do, then you will be getting earnings available for equity shareholders. So what is this? EBIT minus I1 into 1 minus D minus preference dividend. Correct? Because preference dividend, the tax benefit you won't get. Here it will be EBIT minus I2 into 1 minus D minus preference dividend. So if both are having preference dividend, you just write preference dividend 1, 2. Okay. For example, or some will be having preference dividend, some will not be having any preference dividend. I'm just writing 1, 2. If you're having, you just put, otherwise you don't put. Okay. Now what you will do, divided by number of equity shares. So number of equity shares N1 and N2. Here number of equity shares for this option, number of equity shares for this option. So your EPS is EBIT minus I1 into 1 minus T. If you are having preference dividend, minus preference dividend. If not having any preference dividend, then don't do any minus preference dividend. Here I'm assuming you're not having any preference dividend, divided by N1. And here it is EBIT minus I2 into 1 minus T divided by N2. Now, when these options will be indifferent, this option will be indifferent because if the EPS is more for this, you'll be choosing this. If your EPS is more for this, you will be choosing this, and it is on the basis of EBIT. So here EBIT is the unknown value. Okay, EBIT is the unknown value, all others are the known values. So what you want to do, you want to find out the EPS, I mean the EBIT level at which both are equal. When both will be equal, when EPS is equal, only then this will become indifferent. Okay, now you are getting an equation. So for the equation is EBIT minus I1 into 1 minus T divided by N1 is equal to EBIT minus I2 into 1 minus T divided by N2 divided by N2. Here EPS is, I mean EBIT is the unknown value. So here EBIT is the unknown value. And you have all the options here. You equate it and you get the EBIT. So your answer will be EBIT. Suppose you're having an EBIT of 10 lakh rupees now. At 10 lakh rupees EBIT, both the options are good. More than 10 lakh, wherever the higher leverage is that is good. Less than 10 lakh, wherever the lower leverage is that is what is good. That is how you have to take a decision. It is something similar to IRR. You have one rate in mind, correct? So where either in the upward, you want to find out the EPS and then you will take the decision. Unless sir, my profit is changing now, the EPS will change. Then again you have to take a decision. So that is the reason you are finding an indifference point. Below this profit, this option is good. Above this profit, that option is good. So this is what is indifference point is helping you. Sir, just ஒரு problem மட்டும் பண்ணா you will get one clarity. Okay. Okay, let us do this problem. Okay, it is very simple problem. If you want to do this, we can do this. Or question number 6 is also good. Okay. Question number 3 you do as homework. Question number 6 I'm doing. Okay. Question number 3 I'm doing. 6 you do it as homework. Both are similar problem. Okay. Both are very similar problem. Here it is 100% equity, alternative 1. Here the debt equity ratio should be 2:1. So which means here entire 60 lakh is equity. Entire 60 lakh is equity. Here my 60 lakh should be 2 should be debt and 1 should be equity. Which means out of those 60 lakh, 2 should be debt and 1 should be equity. So 60 lakh divided by 3 into 2. So which means 40 lakh should be debt and 20 lakh should be equity. Only then my debt equity ratio is becoming 2:1. So here it is 40 lakh debt and 20 lakh equity. So these are my two options. Okay, these are my two options. My interest on debt is 18%, corporate tax rate is 40%. Find out the indifference point. Okay, indifference point. So if I want to find out, okay, just see what third one. Okay, third one. You just write it down. Okay, you just write it down. So first one, you want initial capital of 60 lakh rupees. It has two options of 10 lakh each. So rupees 10 each. Rupees 10 is 60 lakh rupees equity. The 6 lakh rupees is my number of equity shares. Okay, number of equity shares. So first, you write what is I1. Okay, I1 there you are having interest in option 1. First write option 1. In option 1, 60 lakh rupees equity. option 2, ₹20 lakh equity, 40 lakh rupees debt. Okay, 20 lakh rupees equity, 40 lakh rupees debt. This is what is option 2. What will be the interest in option 1? Your interest in option 1 will be 0 because no debt. What will be the interest in option 2? It will be 40 lakh rupees debt into what is the rate? It is 18% rate. So 18%. So my interest will be 40 lakh into 18%, which is 7,20,000. Okay, which is 7,20,000. This is my interest. What is my tax rate? Your tax rate is how much? 40% is your tax rate. Okay, so 40% is my tax rate. Number of equity shares in the first option. So 60 lakh is the equity and 10 rupees is one equity. So number of equity shares is 6 lakh. So 6 lakh is number of equity shares. Number of equity shares in N2, how much? 20 lakh equity. So which means you are having 2 lakh equity shares here. Okay, 2 lakh equity shares here. No preference dividend you are having. Okay, no preference dividend you are having in both the options. So now what you have to do, just write the equation. EBIT minus I1 into 1 minus t whole divided by n1 is equal to EBIT minus I2 into 1 minus t divided by n2. See, you can do this form also, or you can draw a table and then you can do in that form also. Okay, that was the long form, this is a short form. That is what is the difference. Okay, now EBIT minus what is the interest in one? No interest. Okay, so now 1 minus 35%. Okay, 1 minus 35% is equal to, and divided by how much? N1. So N1 is 6 lakh rupees is equal to EBIT minus. So EBIT minus I2. What is your I2? So I2, it is 7.2 lakh rupees. So 7.2 lakh rupees into 1 minus 35%. So 1 minus 35% is equal to 65%. Okay, 1 minus 35% is equal to 65%. So divided by 2 lakh rupees here. Okay, so this 2 lakh is cancelled and this 2 lakh is becoming 3 lakh rupees here. Okay, now EBIT into 65%. So which means 0.65 EBIT is equal to 3 lakhs into 0.65 EBIT. Okay, into 0.65 EBIT. I'm just multiplying 65% inside both. Okay, so into 0.65 EBIT minus 0.65. Okay, 7.2 lakhs. 7.2 lakhs into 0.65. You are getting 4.68 lakhs. Okay, 4.68 lakhs. So 3 lakh into 0.65 EBIT minus 4.68 lakhs. That is what you are getting. Okay. So now what you have to do now next is you multiply. Okay, am I doing correct? Just a minute. Okay. Yes, this is correct. 65%. So 0.65 EBIT minus 4.6. So I'm cancelling this 2 lakh rupees here. Okay, sorry, this is not 3 lakh, this is 3. Okay, because 2 lakh is cancelled by 6 lakh. Now this is becoming 3. Okay, not 3 lakh rupees. That was a mistake. So this is 3. Now what you have to do? Okay, 0.65 EBIT is equal to this 3 you multiply inside. Okay, so 0.65 into 3 you are getting 1.95 EBIT. So 1.95 EBIT minus 4.68 lakhs into 3 is equal to 14.04 lakhs. So 14.04 lakhs. 14.04 lakhs. Now what is happening? This is negative 14.04. So this is coming here. 14.04 lakhs is coming as a positive here. 14.04 lakh is coming as a positive here. Now what is the next one? Next one is 0.65. So which means 1.95 minus 0.65 into EBIT. Okay, into EBIT. That is what I'm doing. So which means EBIT is equal to 14.04 divided by 1.95 minus 0.65. You're getting 1.3. Okay, 1.3. So 14.04 lakh divided by 1.3. So your EBIT is equal to 14.04 divided by 1.3. It is 10.8 lakhs. So EBIT indifference point is equal to 10 lakh 80,000. rupees. Okay, this is how you have to solve the problem. If you just see the answer for third one, you will get 10,80,000 rupees. Okay, 10,80,000 rupees. Sorry. So this is 10,80,000 rupees. I'm just doing it, I'm just doing it one problem so that you get some clarity. Okay, so this is what is indifference point. You do, one or two problems as homework, so you will get to know these things. So are you all with me here? Just put a yes in the comment box. Get some clarity. Okay, just put a yes in the comment box so that I'll get to know that yes, you are here. Okay, very good. Same. Okay, now let us go into the next topic. Okay, let us go into the next topic, which is called as financial break-even. See, all these are very simple topics. Okay, all these are very simple topics, but lot of people, ignore these topics. Lot of people ignore these topics when it comes to examination. When examination, someone is asking financial break-even point, you will be very confused. Are you what is financial break-even point? But all these are very small, putty topics, very easy to calculate. Now, when I'm talking about financial break-even point, so financial break-even point is the EBIT level at which your EPS is 0, which means what should be my EBIT level? Okay, which means the break-even point. What should be my EBIT level at which I am earning nothing? Okay, at which the shareholders are earning nothing. Which means what, no, sir? My EBIT should be 0, right? Then it will not be earning. See, your EBIT will not be 0. If your earnings is 0, your EBIT will not be 0. I mean, if your EBIT is 0, your EPS will not be 0. Your EPS will be negative. Why, sir? Suppose your EBIT is 0. You have to pay interest, correct? Interest, so definitely you have to pay. It doesn't mean that I'm earning nothing, I will not pay interest. You're earning nothing, you have to pay interest. So if you pay some 10 lakh rupees interest now, your profit before taxes is becoming 10 lakh rupees. Are you with me? So profit before taxes is becoming 10 lakh rupees, then taxes, then comes the profit after taxes, earnings available to equity shareholders, number of equity, your EPS will be negative. So what they are telling is that, sir, how much minimum earning I should have, sir? How much minimum earning I should have that will become my EPS 0, okay, which is nothing but the break-even point. Costing also some break-even point you're studying, correct? Costing, what is the break-even point? Fixed cost divided by contribution. Fixed cost divided by PV ratio, correct? Fixed cost divided by PV ratio is your break-even point. So which means you have to at least recover your fixed cost. That is what I'm trying to tell. So here, what is the fixed cost? Here the fixed cost is interest. Okay, here the fixed cost is interest. So here also interesting. There, why it is PV ratio? You are having two expenses. One more expense is variable cost. Here nothing called as variable cost like this is there. Okay. So here in simple terms, if I want to say EBIT minus interest. Okay, this will be your profit before taxes. I mean, earnings before interest and taxes minus interest, earnings before taxes minus taxes, become your profit after taxes. Okay, profit after taxes. Say you're not having any preference. This is what is the number of equity. So number of equity shares will become your EPS. Okay. Now what you want your EPS should be 0. So if you want your EPS should be 0, suppose you're having over 10 lakh shares. Now if you want your EPS should be 0, your profit after tax should also be 0, correct? When your profit is 0, then divided by number of equity shares will become 0, which means to bring EPS 0, your PAT should be 0. When your PAT will be 0, if your PBT is 0, automatically your taxes will be 0 and your PAT will also be 0. Are you all with me? Okay. Sir, அப்படின்னா என்ன அர்த்தம்னா, if I want my PAT as 0, my profit before taxes should also be 0. Sir, when will my profit before taxes will be 0, sir? My profit before taxes will be 0 when my EBIT and interest are same. Are you all with me? If my EBIT is 10 lakh rupees and my interest is also 10 lakh rupees, with then only my EBIT will be same. So which means my EBIT and interest should be same to become my profit before taxes 0. Apina sir, minimum I should earn something which is called as interest. So that is what is earnings. Okay. So how much should be my earnings? My earnings should be minimum what is my interest. If I earn this much, my EPS will be 0. So அப்படின்னா சிம்பிளா சொல்றேன்னா financial break even point is equal to interest. Okay, financial break even EBIT level. So which means your EBIT should be your interest. Are you all with me? Okay, sir. So அப்படின்னா financial break even point நால என்ன அர்த்தம்? Interest. So interest is what is called as the financial break even point. Simple நம்ம சொல்ல முடிச்சிடலாம். Okay. So if someone is asking you what is the financial break even point, so you just have to write out the interest amount. So if you're earning interest, your EPS will become 0. So preference dividend இருந்தா என்ன சார் பண்றது? Already said that preference dividend is a before, interest is a after tax number, before tax number. So preference dividend இருந்தா preference dividend divided by 1 minus t பண்ணு. ஓகேவா? So this is what is a financial break even point. This is what is a financial break even point. If you calculate this, you definitely will get your EPS as 0. Okay. If financial break even point EBIT starting point வச்சுட்டு நீங்க calculate பண்ணா you are going to get your EPS as 0. So financial break even point is equal to interest plus preference dividend divided by 1 minus t. Sir, ஏதோ ஒரு ப்ராப்ளம் காட்டுது சார். Is there anyone where financial break even point is asking? See, here they're asking financial break even. You do this problem on your own. Okay, fourth problem you do on your own. 3 financing plan. Okay, so which means 3 option. Total investment is 2 lakh rupees. So 2 lakh rupees, 3 options. First 100% equity, second equity debt preference, 50 equity, 50 debt, third 50 equity, 50 preference share. So option 1, option 2, option 3. Cost of the debt 8%. So 8% is the interest, 8% is the dividend, tax at 50%. Equity shares 10 rupees issued at a premium of 10. So it is issued at 20 rupees. Okay, it is issued at 20 rupees is the issue price. Expected EBIT is 80,000 rupees. So start from EBIT, find out what is the EPS. Okay, so this is the first tip. Find out what is the EPS. Second thing, find out what is the financial break-even point. So here financial break-even point is nothing. In the first case, financial break-even point will be 0. Because interest also not that, preference dividend also not that. Here the financial break-even point will be interest. Here the financial break-even point will be preference dividend divided by 1 minus t. Here interest is 0. Are you all with me? So அப்படின்னா அப்படியே ஆன்சர் கட் பண்ணிட்டு பாரு. And I'll just give you the answer here. I will not see the answer. நான் அப்படியே financial break-even point சொல்றேன். ஓகேவா? என்ன கொஸ்டின் அது? கொஸ்டின் நம்பர் which question was that? This is question number 4. Okay, question number 4. Now see question number 4. First case financial break-even point will be 0. Okay, first case financial break-even point will be 0. Second case financial break-even point will be interest. Okay, what is the interest amount? It is 8% into 1 lakh. 1 lakh into 8%. Okay, so second case financial break-even point is 8,000. Third case, it should be preference dividend divided by 1 minus t. So preference dividend is 8,000. So 8,000 divided by 1 minus t. What is the tax rate? Tax rate is how much? 50%. So 1 minus t is also 50%. So this will be 16,000 rupees. So this is what is my financial break-even point. A let 0, 8,000 and 16,000. See the answer? No interest. So no financial break-even point is 0. Financial break-even point is 8,000. Financial break-even point is 16,000. Simple, correct? And then find out the indifference point for 1 and 2. Okay, what 2, 1 and 3 and so like this, you have to find out the indifference point also. And few cases there will also be no indifference point. No indifference point, you won't be able to find out indifference point, which means where the EBIT 0.5 both will be same, which means there is no indifference point. Like this also you'll get a question. So sir, now financial break-even point is also completed. Okay, financial break-even point is also completed. Next, okay, next we are going to see, we have certain theories for capital structure. Okay, so that is what is called as capital structure theories. Capital structure theories என்ன சொல்றாங்கன்னா, we have two types of theories. One is theories of relevance and another one is theories of irrelevance. என்ன சார் சொல்ல வராங்க relevance irrelevance? What they are trying to tell. So what they are trying to tell in capital structure theories is that we have two set of theories, which means one person is telling that capital structure is irrelevant. அப்படின்னா, you keep whatever capital structure, it does not affect the value of the firm. Value of the firm, wealth. Okay, value of the firm, the wealth of the company. Okay. So what they are trying to tell is that, sir, whatever you keep the capital structure, your value of the firm will not change. That's irrelevance. So which means capital structure decisions are irrelevant. We don't take any capital structure decisions itself, sir. You know, whatever be your capital structure, your value of the firm is constant. That is what they are telling. Relevance is another. What they are telling is, you change your capital structure, your value of the firm will change. So relevance theory, like you should have the capital structure in such a way where the value of the firm is maximum. That is what they're trying to tell. Okay, so அங்க EBIT, EPS, MPS analysis எப்படி நீ சேஞ்ச் பண்ணா உங்க மார்க்கெட் பிரைஸ் சேஞ்ச் ஆகுது கரெக்டா, அதே மாதிரி வேல்யூ ஆஃப் தி ஃபர்ம் பேசிஸ்ல அவங்க அனாலிசிஸ் பண்ணுவாங்க. So we have two set of persons settling two set of theories. Okay, both all the theories are based on some assumptions. So which theory is correct, sir? Nothing is correct, nothing is wrong. Okay, all are on the basis of assumption. Actually everything is wrong practically. I'm just telling all are on the basis of some assumptions. We have a lot of assumptions that we are taking. Basis that assumptions, we are calculating the value of the firm, and then we are checking whether the capital structure is ideal or not. Okay, sir. So which means we have theory of relevance and theory of irrelevance. So in the theory of relevance, we have net income approach. And the theory of irrelevance, we have net operating income approach. We have net operating income approach. These are some of these are the two important things that we are going to study: net income approach and net operating income approach. 50% of the time questions are asked from this only. Okay, and one more theory of relevance, that we have a traditional approach. Traditional approach is simple. Okay, so traditional approach, this also comes under theory of relevance. And theory of irrelevance, we have one thing called as MM. Okay, MM approach. So MM approach arbitrage. Okay, MM approach it is arbitrage. So based on arbitrage, they will be calculating, and then they will be showing that capital structure decisions are irrelevant. Now this is rarely asked in the examination, arbitrage, and this concept is also, many students don't understand how to do problems of arbitrage. But if I want to do this, or if I want to teach this arbitrage, it will take me around 1 to 1.5 hours. So that is the reason it is not feasible for me to teach this arbitrage concept in revision. I cannot even revise it because most of the people don't even know how to do arbitrage. So revision is also not possible. I have to teach from starting only. And if I teach from start, it will take me around 1.5 to 2 hours. So that is the reason this arbitrage alone I will not be taking in the interest of time. Point number one. Second, very less weightage for the examination also. So which means rarely examination and the problem rarely or 3 to 4 exam or 4 to 3 to 4 years one time on the question. But yeah, you study on your own. Okay? You study on your own, you see on the study material. Or what I will do, now 2 hours video for arbitrage, 2 hours video next week video in the YouTube channel. From there you learn arbitrage. Okay, from there you learn arbitrage. This is what I can do something. But now for this revision class purpose, I will not be taking arbitrage. So in the net income approach, I will be taking, net operating income approach, I will be taking, traditional approach, I will be taking. Okay, traditional approach, I will be taking. Okay, so now let me start with net income approach and net operating income approach. Okay, net operating income approach. What we are going to do, like 1 hour is completed, right? So we'll just take a small or 5 minutes break we'll be taking, or 5 to 7 minutes break we will take, and then we will be continuing with net income approach and net operating income approach. Okay, this time, my pace is little speed. I'm thinking my pace is little speed, or you let me know if you want me to slow down, okay, or if you want me to take one more session, because tomorrow will be the last day. Or if you want, no sir, we want one more session also, and to take cover other topics, and so you can let me know in the live chat, so that basis that I will be taking decisions. So now we'll be taking a small 5 to 7 minutes break. Let me know if the pace is proper and you're able to understand. End of the day, okay, ma, I will be speaking, but what is more important is whether you are understanding or not. So let me know whether you are understanding it or not in the comment section in the live box, so that we'll be taking it accordingly. So let us take a small 5 to 7 minutes break, and then we'll be continuing net income approach and net operating income approach. One of the very important topic, okay, in the capital structure decision. Two things are very important. EBIT, EPS, MPS analysis is one important thing, where indifference point and financial break-even also are connected topics. Second is this net income, net operating income approach. If you know this both, 95 percentage of the weightage for this chapter is completed, and the 5% weightage that I'm giving for MM. So 95 percentage chances that any problem it will come on capital structure decision, you will be able to handle if you know these two things: EBIT, EPS, MPS analysis, indifference point, and then that financial break-even point. All the three are related, which is nothing but income statement. And the second one is net income, net operating income approach. Other traditionally, it's a very small topic that we'll be discussing it. Okay, so let us take a 5 to 7 minutes break, and then we'll be continuing it. Okay. So now let us continue with net income approach and net operating income approach. So just put a yes in the chat box. Just let me check. Can I have some response in the chat box? Yeah, okay, fine, fine. I got a response. Okay. Now, net income approach and net operating income approach are very simple. Okay, I'm not going to go very in depth because again it will take a lot of time because understanding to make you understand this it will take me at least 1 to 2 hours. But I'll just give you a structural discussion about what is net income and net operating income approach. Now see in a balance sheet, we are having a liability side and the asset side. Okay. Suppose you are having share capital and debentures. Here we are taking an assumption that the sources we have only four sources, equity and debt. That is one of the assumptions that we are taking here. Okay, in net in this capital structure decision, one of the assumption is that we are having only two, which is share capital and debt, equity and debt. I mean equity and debt. Now suppose you're having 100 crore rupees. Okay, coming from equity and debt, 100 crore rupees. And this is invested in different assets. Okay, this is invested say land, building, okay, inventory, other assets. You're having this 100 crore rupees. You're having land, inventory, 100 crore rupees. Now if I want to acquire a company or if I want to purchase a company, what I want to do, I want to find out the value. So the first way is I will value the land, I will value the building, I will value all my investments, I will value all my inventory, I'll value my other assets. Okay, say in the balance sheet 100 crore is written, but the market value can be 200 crores. Correct? Land is always valued at cost. 100 rupees, 1000 rupees, like we would have purchased the land, but the purchase value of land today would be 1 crore rupees also. Maybe 1940s they would have purchased, but today, but in the balance sheet it will be sitting in the cost only. But now what you want is that you want a market value. So if you want to value any company, the first method is that value all the assets, add that will be the value of the firm. But that is very difficult, correct? Practically not possible. A company will be having thousands of assets. How will you value? Second way of valuation will be value the equity, value the debt. That is what is equal to value of the firm. Correct. So that is the asset side approach, liability side approach. So which means value of the firm is equal to value of equity, that is called as S, and value of debt, that is what is called as D. That is what is the value of the firm. Are you all with me? So this is the first formula. Value of the firm is equal to S is nothing but value of equity, and D is nothing but value of debt or value of debentures. Okay, equity and debentures only. Okay, now this is what is I am understanding. Okay, value of the firm is equal to value of the equity plus value of debentures. Now, S, how will I find out the value of equity? See, to find out any value, you know that the earnings available to that particular person. Okay, the earnings available to that particular person divided by the cost. If you write, for example, I'm having debentures worth of 10 lakh rupees. I'm having debentures worth of 10 lakh rupees and the interest rate is 10%. So which means I'm having interest of 10,000 rupees. Sorry, 10 lakh into 10%, 1 lakh rupees. Okay, I'm having interest of 1 lakh rupees. This is the debentures and this is the KD. Okay, KD. So I'm putting KD because I want to find out the market value. I don't want to find out the balance sheet value. So that is the reason I'm not putting interest rate. I'm putting KD. KD, I will get the market value. So which means if at all I want to find out the value of debentures, if at all I want to find out is value of debentures, what I will be doing here is that interest divided by KD. Correct. So 1 lakh divided by 10% panna, I am going to get value of debentures, which is what is called as 10 lakh rupees. So interest is what? Okay, my interest is the amount that you're paying to the debenture holders. Now for equity shareholders, what you will be paying? You will be paying dividend. So dividend, how much you'll be paying, which is the earnings available to equity shareholders. So here we are taking one more assumption is that 100% of the EPS is paid as dividend. So dividend payout ratio is 100%. So dividend payout ratio is 100%. That is the assumption that we are taking. So what is the EPS? Okay, well, EPS is nothing, EBIT minus interest. Okay, EBIT minus interest is the earnings available to equity shareholders because we are not having any preference dividend here. And also we are taking one more assumption, the tax is also 0%. Yes, Rahul assumption எடுத்துக்கிறீங்க because this is where the capital structure theory is designed. So capital structure theory, the first assumption is that only two sources of equity. I mean only two sources of capital, equity and debt. Second one is that dividend payout ratio is 100%. Third one is that tax is equal to 0. Okay, tax is equal to 0, which means no taxes. Which means no taxes. All these are the assumptions. Okay, all these are the assumptions that we are using. Sir, appina value of equity if I want to find out. Okay, value of equity if I want to find out. First, and the debentures, correct? What? And then EPS. EPS divided by what you are going to do. If you want to find out the price, na EPS, the K is equal to EPS divided by MPS, correct? What you want to find out is the market value. So it is EPS divided by K, correct? It is EPS divided by K. How will you find out EPS? EPS nale it is EBIT minus interest, okay, into 1 minus T into 1 minus T divided by N, correct? That is what is the EPS. So here interest is, okay, here interest is 1 minus T, you don't have any taxes, correct? 1 minus T, you don't have any taxes. So 1 minus T will not come. So EBIT will come minus interest will come. This is what is the total, this is what is the total earnings available to equity shareholders. I want to find out the total value of equity. So divided by K is the value of equity. Same way, value of debt is equal to, you know the formula, okay, it is KD is equal to I into 1 minus T divided by NP. NP is nothing but the market price of debentures. So market price of debentures. So D அப்படியே இங்க வந்துரும். So D is equal to I into 1 minus T divided by KD. And tax இல்ல. So I divided by KD. So D is equal to I divided by KD. Okay, sir. So now we know value of equity is equal to EBIT minus interest divided by KD. Value of debt is equal to I divided by KD. Value of the firm is equal to value of equity plus value of debt. Okay. So now three formulas you know. Okay, three formulas you know. First formula, value of the firm is equal to value of equity plus value of debt. I'm explaining all the formulas. Second formula is value of equity. It is nothing but EBIT minus I, which is earnings available to equity shareholders divided by the cost of equity. Value of debt is equal to interest divided by KD. Okay, interest divided by KD. Now this is what is the value of debt. Okay, sir. Now, okay, now if at all you want to find though, which means value is nothing but what is the earnings available, what is the cost. Okay, so value of the firm now, the earnings available for the company divided by the cost of the company. This is what is the value of the firm. Correct? So value of the firm, I can also write it as EBIT divided by Q. So value of the firm can also be calculated as EBIT divided by Q. So here, earnings available to equity shareholders divided by cost of equity. Earnings available to company divided by the cost for the company. This will be the value of the firm. Okay, so are you all with me? And the clarity of the quarter. Okay, whatever we are discussing, you're having this clarity, correct? Okay. So which means till now you saw four formulas. Okay, four formulas. First formula, value of the firm is equal to value of equity plus value of debt. Value of equity is equal to EBIT minus I divided by KE. Value of debt is equal to I divided by KD. Value of the firm is equal to EBIT divided by KE. Okay, so these are the four formulas that you learned. Okay, these are the four formulas that you learned. Okay, sir, these are the four formulas that you learned. Now, till now, we don't have any taxes. Okay, so in the formula, till now we don't have any taxes. Now, we are going into, these are the four basic formulas that you should know. And this formula is correct only if the assumptions are correct. Okay, well, the assumptions are only two are there, which is equity and debt. And second one is the expectation of the shareholders are equal. So that is the reason divided by K. Third is no taxes are there. Okay, so all these are the few assumptions that you have to make. So these assumptions are really unrealistic. That is the reason this formula cannot be used practically. But yeah, you should know these formulas. Now, what is net income approach and what is net operating income approach? Net income approach now, you're finding value of the firm using net income. Net income na earnings available to equity shareholders. You're finding value of the firm using net income now, earnings available to equity shareholders. Net operating income approach now, you're finding value of the firm using operating income. Okay, operating income na EBIT. So which means value of the firm you're using finding EBIT. So EBIT divided by Q. This is what is net operating income. So net operating income approach, how will I find out value of the firm? You have to find out value of the firm using net income approach. So first what you have to do, you have to do EBIT minus interest. This is what is net income, correct? Net income EBIT minus I. So EBIT minus I vechittu divided by K pantu, first you find out value of the equity. Okay. Then you find out value of the debt. Then you find out value of the firm is equal to equity plus debt. This is what is net income approach. This is what is net operating income approach. So here KE will be available with you. Here KO will be available with you. So that is the reason you have an assumption here. Okay, well, here the assumption is K is constant. And here the assumption is KO is constant. So here using KO, you are finding net operating income approach. Here using K, you are finding net income approach, like you are finding value of the firm. Okay. So here K is constant, and using this K, you will find out KO. So KO is found here, and here K is found. Okay, but K is found. Sir, how you will find KO? K is sir. Once you found out value of the firm, and the value of the firm, then the minus debt, you will get value of the equity. Okay, value of the equity, then you can find out minus interest, you can find out K. Here, KO you can find out. How you have to find out KO? EBIT divided by value of the firm. So value of the firm, EBIT divided by value of the firm, you will get KO. Correct? Because KO is nothing but EBIT divided by value of the firm. So here KO is found and here K is found. Here K is constant, here KO is constant. This is the simple. I'm not drawing graph and all, because if I want to draw graph now, and the explanation I have to give, so that will take a lot of time. I'm just doing the calculative part, which is very much helpful for the examination. So net income approach, now you're finding value of the firm using net income. So first find out the net income, EBIT minus I divided by KE. Okay, so steps first find out EBIT, then minus interest, okay, but then you do minus interest. So this is EBIT minus interest. EBIT minus interest divide by KE, okay, so just divide by KE. So once you do EBIT minus I divide by KE, you will get value of equity. Then just add debt, you will get value of the firm. Okay, you will get value of the firm. So here KE is something which will be given. The KE is something that will be given. So K will be given. Now you know value of the firm. Now what you want to find out? You want to find out KO. So KO is nothing but EBIT divided by value of the firm. You have EBIT value also and you have value of the firm value also. So now you find out KO. KO is something that you have to find. Okay, KO is something that you have to find. Are you all with me? And value of the firm is the value. So this is the step which is there in the net income approach. Sir, net income approach sir. Net income approach net operating income approach sir. First EBIT you are having. Directly divide KE. Here KE, sorry, KO. So here KO is given. Okay, but here KO is given. Directly if you divide by KO, you will get value of the firm. Okay, you will get value of the firm. Okay. So now value of the firm is over. So now what you have to do? You have to find out KE. You have to find out KE. How to find out KE? KE maybe find out from where? Okay, well, here EBIT minus I divided by S, correct? So what you are going to do? EBIT minus I divided by S. Okay, divided by S. How will I find out, sir? EBIT minus I. EBIT will be there. I will be there. S you have to find out. How will I find out S, sir? Okay, how will I find out S? Value of the equity. EBIT minus I divided by. So S, the value of equity will be given. Up there you find out K. So this is how you have to do the problem. Okay, EBIT minus I divided by S. You have to find out K. So here you have to find out KO. Here you have to find out K. So here K is constant. Here KO is constant. Here K is constant. And here KO is constant. So this is what is net income approach and net operating income approach. Okay, sir. சும்மா ஒரே ஒரு ப்ராப்ளம் மட்டும் போட்டு காட்டுறேன் so that you will get that clarity. Whenever, if sir, how will I find out whether I should use K or net income or net operating income? Sir, whenever K is given, it is always net income approach. Okay, ma'am. KO is given, so this is net income approach. So wherever KO is given, for example, in this problem, okay, in this problem, K will not be given overall cost of capital. KO is given. Okay, here KO is given. Now KO is given. Now this is net operating income approach. So we are going to do both the illustrations: net income approach and net operating income approach. Okay, now let us see. So K is given, so net income approach. Now I said first you do EBIT. EBIT is given 1 lakh. EBIT minus interest. So 5 lakh into 10% minus interest. It is earnings available to equity shareholders. So EBIT minus I. So EBIT minus I divided by K. Just do divided by K, you are going to get value of equity. Now what is value of debt? Directly given 5 lakh rupees. Okay. So plus 5 lakh rupees, you are going to get value of firm, which is 8,33,333. So value of the firm is 8,33,333. So overall cost of capital, how will I find out? Overall cost of capital is nothing but EBIT divided by value of the firm. So EBIT is 1 lakh, value of the firm is 8,33,000. So 1 lakh divided by 8,33,333, it is 12%. So overall cost of capital is 12%. அப்படியே net income approach over. Very easy problem. அப்படியே the problem. So let us do illustration number 4 now. Net operating income number. Find out the value of the firm. How will you find out the value of the firm? Already said EBIT divided by K open. Okay, what is EBIT? 5 lakh rupees. Okay, what is EBIT? 5 lakh rupees. What is KO? 15%. So EBIT 5 lakh. Okay, show value of the firm. EBIT 5 lakh divided by KO, you will get 33,33,333. So this becomes your value of the firm. 33,333. So now I want to find out the cost of equity. Cost of equity is nothing but EBIT minus I divided by S. So now you want to know what is the value of equity. Value of equity is nothing but total value of the firm minus value of the debt is equal to value of equity. So total value of the firm is 33 lakh. What is the value of debt? 15 lakh. So value of equity is equal to 33 minus 15. Okay. So 33 minus 15 panna, you will get value of the equity, which is 1833,333. Okay. So S is equal to 1833,333. So EBIT minus I divided by S panna, you are going to get cost of equity. Correct? EBIT minus I divided by S panna, you are going to get cost of equity. So what is EBIT minus I? EBIT is 5 lakh. What is interest? 15 lakh into 10%. So it is 1,50,000. So 3,50,000 is interest. So 3,50,000 divided by 1833,333. So 3,30,000, 50,000 divided by 1833,333. You are going to get cost of equity, which is 19.09%. So now it is over. Okay, so net income approach is also over. Net operating income approach is also over. Okay, so up here you want to do the problem. Okay, and with this net income approach and net operating income approach is completed. See, whatever is relevant for the examination perspective, I'm taking that much only. Okay. So now net income approach and net operating income approach is over. Modeling and Miller, I told that I will either put a YouTube video and you see and you see and you understand it. It is on the basis called as arbitrage. So what is traditional approach? Last, what is traditional approach, sir? Okay. Now, traditional approach now, what you are doing is that you are finding the overall cost of capital. Wherever the overall cost of capital is low, அதுதான் பெஸ்ட் கேபிட்டல் ஸ்ட்ரக்சர். சிம்பிளா அவங்க அப்படியே பண்ணுவாங்க. ஓகேவா? ஸோ டிஃப்ரெண்ட் ஆப்ஷன்ஸ் கொடுத்துருவாங்க. வேர் எவர் தி காஸ்ட் the KO is low, that is where you have to find out. KO na என்னது சார்? Weight of, how will you find out KO? Weight of equity into cost of equity plus weight of debt into cost of debt is equal to Q. That is what you find out, correct? And then our Q on the table, if I don't know, that is what I'm writing in that formula. Weight of equity into cost of equity plus weight of debt into cost of debt is equal to Q. Now, when you are having only two sources of capital, so weight of equity into cost of equity, weight of debt is nothing but 1 minus weight of equity into cost of debt, you are going to get cost of, the overall cost of capital. Wherever the overall cost of capital is low, that is what is the best capital structure. Okay, well, so just see the traditional approach. Now here, see, in net income and net operating income approach, either KE or KO is constant. On a traditional approach, both will be changing under traditional. See, cost of debt is changing, cost of equity is changing. Okay. So now what is this percentage of debt on total value? So which means debt divided by total. So this is weight of debt. Okay, but this is weight of debt. So you want to find out weight of equity. So debt is 0 now, equity is 1. Weight is 1. This is 0.9. This is 0.8. This is 0.7. This is 0.6. This is 0.5. This is 0.4. Weight of equity. This is cost of debt. This is cost of equity. Okay. So weight of debt into cost of debt plus weight of equity into cost of equity is equal to the overall cost of capital. That is what you do. The overall cost of capital. So 11 percentage into 0 plus 13 percentage into 1. So 13 percentage is the overall cost of capital. So wherever the overall cost of capital is lower, cost, wherever the cost is lower, that is the best capital structure. Where it is lower, you see at 12.8 is lower. So choose option number 2. Okay, choose option number 2, which is 10 percentage equity. So this is the option number 2 is the answer. So that is how you have to solve traditional approach. Okay, that is how you have to solve the traditional approach. So with this, we are ending capital structure decisions. Okay, with this, we are ending capital structure decisions. Now, what I want is that net income and net operating, because it is very, very important. So yeah, net income and net operating income, which is very, very important. Just 1 minute. I want you to solve one problem with me. Let me take the RT. Let me take the RT. Okay. Do question number 3. I'm giving you, this is an exam question. Here, both they're asking net income approach, net operating income approach for both the companies. So company P and company Q are identical in all aspects. Okay, are identical except for net equity. Company P is having 10% debentures of 18 lakh rupees, while company Q is unlevered. Unlevered na no debt. Okay, unlevered na no leverage, no debt. Both the companies earn 20% before interest and taxes on their total assets. So their EBIT is 20%. So 30 lakh into 20% is that 6 lakh rupees is their EBIT. Okay. Assuming a tax rate of 50% and a capitalization rate of 15% from an all equity company, calculate the value of the firms of P and Q using net income approach and net operating income approach. Sir, இங்க tax rate கொடுத்திருக்காங்க. Okay, tax rate கொடுத்திருக்காங்க. Tax rate கொடுத்திருக்காங்கன்னா என்ன சார் பண்ணும்? Okay, tax rate கொடுத்திருக்காங்கன்னா என்ன சார் பண்ணும்? See, one thing is that the value of, okay, one formula that I want to teach you here is that the value of levered firm and value of unlevered firm. Okay, value of levered firm, value of unlevered firm. First, levered firm na, a firm which is having taxes. Okay, wow. I mean, sorry, a firm which is having debt. Unlevered firm na, firm with no debt. Okay, wow. Firm with no debt. So which means a firm which is having debt. அவங்களுக்கு என்ன இருக்குன்னா அந்த டெட்டுக்கு அவங்க இன்ட்ரெஸ்ட் பே பண்ணுவாங்க கரெக்டா அந்த டெட்டுக்கு அவங்க இன்ட்ரெஸ்ட் பே பண்ணுவாங்க and this interest they will be saving some taxes. Okay, but this interest they will be saving some taxes. So I into okay, I into P is the savings on taxes that they're going to make. Okay, so which means if they're paying 1 lakh rupees interest na adala 30% tax rate na 1 lakh into 30% 33 1 lakh into 30% 30,000 rupees they will save every year. So save every year na perpetually they are saving and their cost of debt is KD na I divided by KD is debt into taxes. Okay, so this is their overall saving that they're making. So usually value of levered firm is equal to value of unlevered firm plus debt into taxes because this is their extra addition this is their extra savings that they're making because of debt. So value of levered firm is equal to value of unlevered firm into debt into taxes. Okay, or plus the debt into taxes. So which means what you have to do, unlevered firm the value you kandupidichiru. So levered firm how will I find out the value? It is unlevered firm the value plus the debt into taxes. That is the value of levered firm. Okay, in the formula this is one more formula. Whenever taxes is coming, only then you have to use this formula. Now you do this problem. Okay, one net income approach, net operating income approach use to do this problem. I'm giving you a 5 minute time. Okay, or 5 to 7 minutes time in the problem. Okay, so I received an answer from Hemalata. I got that. I just noted down the answer that I got. Net income approach for P it is 46 lakhs. For Q it is 40 lakhs. Net operating income approach for P it is 49 lakh and for Q it is 40 lakh rupees. Okay. Now let us check. Let us check the third one. So net income approach, it is 32 lakhs. It is 32 and 20 lakh. So I understood the mistake that you would have done is that you would have not taken taxes here. Okay. I already said that if taxes are there, then net income you have to reduce taxes also. So this is the one of the mistake that you would have done, I'm very sure. Because the answer that you got is for net income 46 and 40. Okay, 46 and 40. So how you would have got 46 is that you would have done EBIT 6 lakh minus 180, you would have done 4 lakh 20,000. And in the 4 lakh 20,000 direct you would have done divided by 15 percentage, that is 28 lakh. Then you would have added 18 lakh rupees. Correct? Like this, you are getting 46 lakh rupees, I'm sure. But you have to reduce taxes. So I'm very happy that you did a mistake. So when you did a mistake, you understood that when taxes are there, net income you have to reduce taxes. Okay. Very. So value of the firm 32 lakhs and 20 lakhs. அப்போ இந்த net operating income approach நான் எப்படி சார் பண்றது? Net operating income approachல again you have to do net operating income after taxes. So EBIT into 1 minus T you have to do, which is called as operating income after taxes, divided by 15% panna. Okay, well, divided by 15% is the overall cost of capital, correct? Which is given cost of capital. So 15 capitalization rate of 15% from an all equity company. So all equity company capitalization rate is 15%. Na KO is equal to 15% for all equity company. So for all equity company, the KO is 15%, which means for unlevered company, the KO is 15%. So first you have to find out the value of unlevered company, which is value of Q. So 6 lakh into 1 minus 0.5 divided by 0.15, you will get 20 lakh rupees, which is the capitalization of earnings. Then what you have to do? You have to do less value of debt. Okay. So debt into taxes, correct? You will get value of equity. Then you add the total value of debt, you will get the total value of equity, 29 lakh and 20 lakh rupees. So 29 lakh and 20 lakh rupees. And the formula that you use, you will get. So which means what you have to do? First, you have to find out the value of the firm for unlevered company. So, which is unlevered company? Q is the unlevered company, correct? So, it is very easy to find the value of the firm, which is nothing but, okay, first, it is value of levered firm is equal to value of unlevered firm plus debt into taxes, okay, plus debt into taxes. So, first, what you have to do, you have to find out the value of the unlevered firm. So unlevered firm KO is equal to K. So K is equal to 15%. Then EBIT into 1 minus T divided by 15%, you will get for 20 lakh rupees, correct? You will get 20 lakh rupees. So value of the firm is 20 lakh rupees. The value of levered firm is nothing but 20 lakh rupees plus debt into taxes. Okay, so how much is debt? 18 lakh rupees is the debt. How much is taxes? 50%. So 9 lakhs. So 20 lakh plus 9 lakh is equal to 29 lakhs. Apply panna clarity. Okay, instead of using this approach, apply panna. So now you found out the value of the firm for value of levered firm also and value of unlevered firm also. 20 lakh and 29 lakh. Same way here also. Okay, 20 lakh and 32 lakhs. Net income approach and net operating income approach. So now you got clarity. You got some clarity here. Abhi answer copy pannigo, seriya? And I'm happy that you did mistakes because it is good to do mistakes now instead of doing mistakes in examination hall. In a highly possibility examination, it is 6 to 8 marks problem, and you could do the same mistake here. So you should be happy. Okay, very good. Very good, Hiplet. I'm very happy. Okay, so 32 and 20 lakh. Sharat also got the answer. Very good. Okay. Now we can move ahead. Okay, now we can move ahead. Now let us move ahead and do investment decision. கொஞ்சம் இருக்குது அதை நம்ம கம்ப்ளீட் பண்ணணும். ஓகேவா? Which means adjustment in investment decision, estimation of cash flows. Okay, investment decision there. What I want to discuss is estimation of cash flows. Any cash flows and the moon of picture. Okay, initial cash flows, annual cash flows, and then terminal cash flows. Initial cash flow is cash flow for year 0. Annual cash flow is suppose the project life 5 years. Suppose you're doing for 5 years now. The cash flows for year 1 to year 5. That is what is annual cash flows. Terminal cash flows now, what is the cash flow that will be in year 5? Okay, well, that is what is the terminal cash flow. So year 5 you will be getting some extra adjustments. So year 5 you're closing the project, scrap value and all that you will be getting, correct? So that will come under terminal cash flows, year 1 to year 5. Now how will I estimate, sir? Sir, initial cash flows like usual and the purchase price. Suppose if it is a machinery problem, no purchase price of the machinery or investment in project. Okay, so it is nothing but the initial cash outlay. Annual cash flows, what I should do? So if it is profit after taxes, first you will be getting something called as sales. And then variable cost minus you will be having some contribution. Correct? Year on year you will do 1, 2, 3, 4, 5. Then you will be minusing some fixed cost. You will get EBIT. Then you will be minusing interest. You will get earnings before taxes. Okay, and there fixed cost there, you will also do minus depreciation also. Okay, why not? Depreciation is also one more fixed cost. They will do depreciation, earnings before interest and taxes, minus interest earnings before taxes, minus taxes, you will get PAT. Now PAT and when you depreciation add panna, you will get something called as cash flows. So either way, all the 5 years cash flows. So terminal cash flows are. For example, if you're selling that machinery, the scrap value will be the inflow. The scrap value will be the inflow. Now, when you're having a scrap value, you will be either be having a capital gain or a capital loss. So if it is a capital gain, then you will be having a tax expense. So that tax expense will be an outflow. If it is a capital loss, you will be having a tax benefit. So when it is a tax benefit, that can be an inflow. Okay, so scrap value will be an inflow. So capital gain okay, capital gain it will be a tax expense, and tax expense is an outflow. So this is an inflow. This is an outflow. This is again an inflow. Okay, this will be the capital loss. So where in the server? Okay, we have one more adjustment which is called as working capital adjustment. Whenever working capital amount is given, working capital is something that you're investing in year 0, and that working capital will be recovered at the end of the project. So initial cash outlay working capital investment, and then at the end of the project life, other working capital will be recovered. Okay, so working capital recovery. So this is again an okay, this is again an so where in the you will be having some opportunity benefit or opportunity cost that that will be there in the annual cash flows also. So suppose you're having any opportunity benefit here. Opportunity benefit now, some cost that you're saving. Okay, well, the cost is saved is called as opportunity benefit. Somewhere you're if you're not doing that, some cost you're saving, some cost you're earning, some cost that you're saving, that is the saving cost, that is opportunity benefit. Okay, well, or some benefit you're foregone now, some benefit you are having now, you're not getting that benefit, so benefit foregone, that becomes your opportunity cost. So the opportunity cost, opportunity benefit, in மாதிரி adjustments all these adjustment we have to find out something called as cash flow table. After estimation of cash flow, you have to find out the NPV. NPV table, okay, on the NPV table, initial 0, 1, 2, 3, 4, 5. So initial cash flow, negative amount. Then annual cash flows, you will get some values here. Then terminal cash flow, you will get the value something in 55. Okay, well, then this will be the total cash flows. So total cash flows. The 0th year outflow and 1 to 5 years inflow. That is something called as the cash flow table. If you have to find out the NPV, which means present value factor at the rate the discounting rate you will get the discounted cash flow. If you total all the discounted cash flow, you will get the net present value. You will get the net present value. If the net present value is positive, you have to accept. If the net present value is negative, you have to reject. That is how a usual problem looks like. Okay, so என்ன பண்ணணும், ஒரு இன்வெஸ்ட்மெண்ட் டெசிஷன் ஒரு சின்ன ஒரு ப்ராப்ளம் மட்டும் ஒன்று பண்ணி காட்டுறேன். Okay, this is the normal problem that we did. Okay, what discounted by profitability index and net present value. Okay, this is the normal capital budgeting problem. This is techniques. This is not the problem that we are looking for. We are looking for a problem where estimation of cash flows are included. Yeah, this problem I already did in YouTube. Okay, this is one more estimation of cash flow problem. See from my YouTube channel. The same problem I did in YouTube. இது மட்டும் நீ பார்த்துக்கோ. Okay, so I'm not doing this problem. YouTube பார்த்துக்கோ. The same problem I did. Okay. This is one more problem. I want you to do it as a homework. So homework, this is May 2019 article. Okay, May 2019 article, 5th one. This is one problem where the cost of machinery is given for 15 years, 10 years. All the years cost are given, rate of depreciation is given. So depreciation minus பண்ணிட்டு tax போட்டுட்டு add பண்ணணும். Okay, let me do this problem only. Okay, this problem. Let us read this problem. Because I want to do one problem. Okay. So pathology lab laboratory is using an X-ray machines which reached at the end of their useful life. Okay, so now two X-ray machines are there, brand A and brand B. Okay, brand XYZ and ABC. This is the cost of the machine. Okay, so 0th year, this is the cost, and here the life is 15 years, here the life is 10 years. So that is the reason here 10 years maintenance cost is given, here 15 years maintenance cost is given. So you know total cost கண்டுபிடி. 0th year what is the cost, 1 to 15 year what is the cost, அதுக்கு present value பண்ணிடு. So that will be the total cost of the machinery, and இதுக்கு what is the cost அப்படியே நீ பண்ணிடு, so that you will get the cost. Then depreciation is there, depreciation every year அப்படியே minus பண்ணிட்டே இரு. So cost, then less depreciation, and அதுக்கு உனக்கு tax benefit கிடைக்கும். ஓகேவா? So depreciation to tax benefit portal as an inflow. Then you calculate something called as the present value of the cost. So wherever the cost is lower, that is the explanation that you have to select. Okay, residual value of both the above machines shall be dropped by 1/3 of the purchase price in the first year, and thereafter it shall be depreciated at the rate mentioned above. So first year la mattum 1/3 the value is reduced, and then the depreciation of this. So depreciation is not directly given. Depreciation is in the money. First year la mattum 1/3 reduce at a value, and then 4% depreciation every year. Alternatively, the machine of brand ABC can also be taken on the rental. So the rental mattum apparama paathukalam. Okay, so first purchase option paathukalam. So which I should purchase? Okay, which I should purchase? Which I should purchase? Let us do question number 5. I'm just going to give you a walkthrough, okay, just a walkthrough. Question number 5. Okay. In investment decisions, okay, in investment decisions, what you're doing is the NPV, okay, NPV. Now, if you're doing NPV for two projects, project A and project B, here the life is 10 years and here the life is 15 years. Now, both this NPV cannot be compared. Okay, because this NPV is for 10 years, this NPV is for 15 years. So, ரெண்டுமே compare பண்ண முடியாது சார். அப்படின்னா நீ என்ன பண்ணணும், you have to find something called as EAC, okay, equivalent annualized NPV, okay. So equivalent annualized NPV you have to find out. You have to find out annualized NPV. So annualized NPV என்னது? NPV divided by 10 பண்ணனும்னா 10 பண்ண முடியாது. ஏன்னா divide by 10 பண்ணா you are not using time value of money. You have to do NPV divided by present value annuity factor for 10 years. And here you have to do NPV divided by present value annuity factor for 15 years. In the Mari Panna, you will get something called as annualized NPV. And this annualized NPV you can compare between both the things. Okay, so since here the case for one is for 10 years and one is for 15 years, Nala, you are finding equivalent annualized cost. Okay, equivalent annualized cost. So first brand XYZ. So brand XYZ, first 6 lakh is the outflow. Then 1 to 5 years, this is outflow. 6 to 10 years, this is outflow. 11 to 15 years, this is outflow. 15th year, you will get this scrap. Okay, 15th year, you will get this scrap, which is 64,000 rupees. Here, 0th year, 4 lakh 50. 1 to 5, this is the cost. 6 to 10, this is the cost. 10th, this is the cost. So all these are present value annuity factors. Present value annuity factor, present value annuity factor, present value factors. Panna, you have to find out the present value. So this is the present value for 20 years, 15 years. So the divided by present value annuity factor for 15 years, Panna, you are getting the equivalent cost as 1,12,000. Here you have to do for 10 years. The same thing you have to do for 10 years. You are getting 1,15,000. So 1,15,000 and 1,12,000. The cost is lower for A. So therefore go for A. Okay, therefore go for A. Since equivalent is least for XYZ, you have to go for XYZ. That is what they're trying to do. You have to go for XYZ. 1,12,000 and 1,15,000. So go for XYZ. That is what they are trying to do. Okay. So in my problems are mostly investment decision problem time okay. Like if I do that problem, it will take half an hour for me to solve my problem. We have some problems that will take half an hour, 45 minutes explaining it and then doing it. So mostly you have to practice the problem. Different types of problem will be having replacement decision. But usually if you do it in this format, you have to do initial cash flow, annual cash flows, and terminal cash flows. If you do this in this format, okay, you are going to get the answers properly and correctly. You are going to get the answers. Okay. So now, today was small, we will be closing investment decisions. Very good problem. Okay, capital budgeting. I'm again giving you a 10 minutes time, but I'll be explaining this problem. 10 minutes time, super in the problem. So MTR Limited is considering buying a new machine which is having an economic life of 5 years. Okay, so life is 5 years, cost is 25 lakh. So 0th year, the cost is 25 lakh. And a scrap value 3 lakh rupees. Scrap value now, at the end of my 5th year, what is my inflow? So my inflow will be 3 lakh rupees. Okay. And this 25 lakh, 80% I want to pay at the 0th year, and 20% I have to pay in the first year. So which means a 25 lakh into 80%. So 20 lakh rupees I have to pay in 0th year. So 0th year outflow will be 20th lakh, and 5 lakh will be the first year outflow, and 3 lakh will be the 5th year inflow. இப்போ சார் ஆனுவல் கேஷ் ஃப்ளோஸ் எப்படி கண்டுபிடிக்கும்? Machine would produce 75,000 units. அதில் the selling price is 300 rupees. Variable cost is 285 rupees per. So 285. So sales minus variable cost பண்ண contribution வரும். Fixed cost including depreciation on straight line will be 8,40,000 rupees. Okay, including depreciation. So up in the 8,40,000 is the fixed cost. Either depreciation eவ்வளோ sir? 25 lakh rupees minus scrap value. So 22 lakh rupees divided by 5 years. That will be your straight line depreciation. So 25 lakh minus 3 lakh rupees is the scrap value. So 22 lakh rupees is the depreciable value. 22 lakh rupees divided by 5 panna, your depreciation amount will be 4,40,000 rupees. So 4,40,000 rupees is your depreciation amount. So this 4,40,000 is included here. So first you have to minus this, okay, wow. In the 8,40,000 lakh, okay, wow, in the 8,40,000 lakh, 4 lakh rupees is the cash fixed cost now. Okay, wow. So 4 lakh rupees is the cash fixed cost, and 4,40,000 rupees is the non-cash fixed cost, because that is what is the depreciation. So less 8,40,000. Adala you will get earnings before interest and taxes. Interest la ஒண்ணுமே இல்ல. So earnings before taxes minus tax பண்ணு. Tax கொடுத்திருக்காங்களா? ஓ tax கொடுக்கல. So tax கொடுக்கலன்னா நீ depreciation direct அப்படியே remove பண்ணிடலாம். ஓகேவா? So don't minus 8,40,000, minus only 4 lakh rupees. That is what they're trying to tell. ஏன்னா tax இல்லை. Tax இருந்தா minus பண்ணிட்டு then you have to add back. ஓகேவா? tax இல்லை. Now in the first year and second year, one more expenditure you'll be having, which is 1 lakh and 1,50,000 rupees. So now calculate the NPV if the discounting rate is 15%. Okay, well, do that problem. Now I want you to do this problem. So watch first initial cash flow. Initial cash flow la 0th year la minus 20 lakh, first year la minus 5 lakh rupees. Annual cash flows, sales minus variable cost minus cash fixed cost. That will be your annual cash flows. Terminal cash flows. Terminal cash flows, the inflow will be 3 lakh rupees at the end. Okay, wow. And then special cash flows, இதே annual cash flows adjust பண்ணிடு. Okay, annual cash flows 1 lakh minus பண்ணிடு, 1,50,000 minus பண்ணிடு. So now you will get 0th year cash flow, 1 to 5 years cash flow, and 5th year cash flow. Then calculate the NPV. Okay, wow. For 10 minutes time I'm doing. Very good problem. If you know to do this problem, other problems also easily you can do. Okay, wow. So I want you to do this problem. Take over 10 to 12 minutes time here. But do this problem. Okay, definitely do this problem with me now. Okay, so do this problem for 15 minutes time. I'm giving you 15 minutes time. Proper, I want all the NPV answers. You write it in the chat box. Okay, write it in the chat box. NPV, you write it in the chat box. I'll be very happy. Okay, if you're writing it. If you're doing it correctly, I'm very, very happy. If you're doing it wrong, also, I will be very happy because you're doing mistakes. So, any case, I am happy only, but do this problem. So, right now it is 4:15. Take for 10 to 15 minutes. Nalla time எடுத்துட்டு do this problem. A particular 5 to 8 mark problem it is. Okay. So we got one answer, negative 1,52,200 rupees is one answer that I got. Let me check. Yes. So 150 to 200 is one answer that I got. And one more answer I'm getting at 55, 6, 17 negative. So I'm getting two answers. Okay. Now let me do this problem. Okay, let me do this problem. So year 0, your outflow of 25 lakh rupees into 80%. Okay, 25 lakh rupees into 80%. So that is 20 lakh rupees. So year 0, you're having an outflow of 20 lakh rupees. That is very good. So year 1, you're having an outflow of 5 lakh rupees. So this becomes your initial cash flow. Very simple. This becomes your initial cash flow. Now what I want is the annual cash flows. So annual cash flows, what I will be doing, I will be doing a working note. A working note would be, first I will be doing sales. Okay, so first I'll be doing sales in how many years? 5 years. Okay, so 1, 2, 3, 4, 5. So first would be the sales. 75,000 units at 300 rupees. So sales minus variable cost and direct contribution, correct? So 300 minus 285 is equal to 15 rupees. So the direct contribution, are you all with me? Sales minus variable cost, unit is same. So the direct contribution, so 300 minus 285 is 15 rupees into 75,000 rupees. So it is 11 lakh 25,000 rupees. So 1 to 5 years, my contribution is 11 lakh 25,000 rupees. Okay, this is 1 to 5 years. 1 to 5 years is my contribution, 11 lakh 25,000 rupees. Minus fixed cost is 4 lakh rupees. As I said, 4 lakh 40,000 is depreciation. 8 lakh 40 is including depreciation. So if I remove depreciation, I will get 4 lakh rupees. So minus 4 lakh rupees is the fixed cost. So once I know the fixed cost, this will become my cash flows. Correct? This will become my cash flows. 11 lakh minus 4 lakh rupees. So 7 lakh 25,000. Okay, 7 lakh 25,000 is my annual cash flows. Okay, 1, 2, 3, 4, 5. But minus some sales promotion expense I'm having only for first and second year, 1 lakh and 1 lakh 50. Okay, 1 lakh and 1 lakh 50. And 1 lakh 50. So if I do this, I will get my net cash flows as 7 lakh 20 minus 1 lakh is equal to 6 lakh 25,000. 7 lakh 25. Okay, minus 1 lakh 50,000. I'm getting 5 lakh 75,000. Okay, 5 lakh 75,000. This will be 7 lakh 25,000. This will be 7 lakh 25,000. And then this will be 7 lakh 25,000. Okay, so these are my annual cash flows. அதே மாதிரி நான் என்ன பண்ணுவோம், present value factor at the rate 15% போடணும். Then I will get discounted cash flows. So the main thing you have to find out is the cash flows. So this is the first 5 years cash flows. This is the 0th year cash flow outflow, first year cash outflow. Then 5th year you will be having one more terminal cash flow. So 1, 2, 3, 4, 5. You write it 1, 2, 3, 4, 5. From here you write it. Okay, all these are inflows. 6 lakh 25,000, 5 lakh 75,000, and 7 lakh 25,000, 7 lakh 25,000, 7 lakh 25,000, 25,000. Then 5th year, again you will be having a scrap value of 3 lakh rupees as an inflow. Many people would have missed this. I know that this would be one of the mistakes that you would have done. Either present value factor put and net present value quota, that will be your answer. Now, let me check. 5th one. First cash flow, correct? Present value is only calculation. 5th one. See, 0th year 2 lakh. Okay, 0th year 2 lakh, first year 5 lakh rupees. Okay, 0th year, first year 5 lakh rupees. 2, 3, 4, 5. It is 11 lakh 25 minus 4 lakh minus 1, 2. Okay, so 125. 125 only like the 5 and 6 go to 125. So 625 is correct. Then 575 is for the second year. 575 is for the second year. Third year, fourth year is 725, 725. And fifth year is 725 plus 3 is nothing but 1025. So 725, 3 lakh. All are correct. So if all my cash flows are correct, definitely what I have to do, I just have to put a discounting factor here, present value quota, I will get the net present value, which is 126,800 rupees. So it is 126,800 rupees. So all of them did wrongly. So the answer is positive 126,800 rupees. Positive 126,800 rupees. So you can put in the comment box what is the mistake that you did. Okay, what is the mistake that you did, so that you would have learned something. What I am assuming is that one of the mistakes that you would have did is you would have missed the scrap value. That is one of the mistakes that you would have did. Second mistake, what you would have did is that what is the second mistake that you would have did? Maybe you would have missed this special promotion expenses also. You would have missed this. This would be the second mistake that you would have done. So in the many mistakes la ningala panna. Or maybe fixed cost வந்து you would have reduced to not 4 lakh, you would have reduced this 8,40,000. You would have reduced to 8,40,000 rupees. Maybe depreciation reduce பண்ணிருப்பீங்க. Okay, but you have to add back depreciation also, right? Because tax impact is not there. So அதனால directly reduce depreciation. If tax impact would have there, I would have reduced 8,40,000 and then I would have added back 4,40,000 so that there would be an impact. So fifth way, the answer is this. So just put it in the comment section that yes, you understood this problem. Okay, this is one of the important problems. So yes, you understood this problem in the comment section about it. Okay, so I saw that one mistake is the second year investment 30 lakh portigo instead of 5 lakh rupees. Okay. Okay, you discounted at 15% rate. Why do you? In the question, it is directly given 12% rate. See, all these are silly mistakes. Okay, we all are doing. Okay, all these are the silly mistakes that we all are doing. The only thing is that you can avoid. So now I'm happy, right? I'm happy that you did a mistake. So what mistake? Okay, now maybe that we quoted another. So what mistake you would have done is that. So in many mistakes, you have to avoid it in the examination. Okay. So now you're doing a mistake. Now in the exam hall, your eyes will be very much open and you'll be aware that, okay, what are all the mistakes that you guys are doing. So once your eyes are open, you're aware now, your mistakes will be happening less. Okay, so you'll be doing less mistakes. So that is what is our agenda for revision, is that whatever the mistakes are possible, do the mistakes in the revision level itself. Okay, do the mistake in the practice level itself, so that you don't do new mistakes in the examination. Do all the possible mistakes now only, so that in the examination, mistakes matter. Okay, but that is the objective. Okay, so with this, we are closing investment decision also. With this, we are closing investment decision. So we have some small topics also. This annual NPV also have completed. We have some small topics like MIRR and all. So MIRR and all, if I take, now it will take some more time. So we will see, okay, body for internal rate of return, less weightage is that is the reason I'm not focusing much in the revision. Okay. So now let us jump into the next chapter, which is ratio analysis. Again, a completely computational chapter. Okay, again, a completely computational chapter. Okay, just 1 minute. So, ratio analysis. Let's start with ratio analysis. Sorry. Now, see, ratio analysis, like you're having lot of ratios, okay? But you don't have to mug up all these ratios. I will be important ratios and the problems can be helpful. Where in the problem exam approach that is what I'm going to teach you. In ratio analysis, more important is how to approach a problem. More than formulas, important is how to approach a problem. If you know this, ratio analysis is a very easy chapter. Sorry, first you're having different types of ratios. Okay, one liquidity ratios, short term liquidity, long term liquidity ratios, turnover ratios, coverage ratios, profitability ratios. These are one by one discuss panilla what are the types of ratios are there, and then we will be going into the next discussion. So first, you all know that sales minus variable cost will be the contribution. Minus the operating fixed cost will be the operating profit. Okay, will be the operating profit. This operating profit is what we call it as EBIT. This EBIT is the earnings which is available for both the equity shareholders and debt shareholders. So minus interest panna, you will get earnings before taxes. Minus taxes panna, you will get earnings after taxes. This is what is the earnings available to equity shareholders and preference shareholders. Okay, wow. Then minus preference dividend panna, you will get earnings available to equity shareholders. Okay, this is the earnings available to equity shareholders. This income statement, this balance sheet, this analysis. Now, balance sheet, first you will be having equity. Okay, first you will be having owners' funds with you. Okay, owners' funds. Then outside funds. So, owners' funds, first you will be having equity share capital. You will be having reserves and surplus. You will be having preference share capital. Okay, then enna solradhu outside. Outside you will be having long-term debts. Okay, long-term debts. Then you will be having some other current liabilities and you will be having, okay, in my creditors life. Here you will be having non-current assets and then current assets. Non-current assets, mostly fixed assets will be there. Current assets, mostly inventory, receivables, cash and bank balances will be. Okay, this is what is the balance sheet will look like. Now, equity and reserves and surplus. Okay, equity and reserves and surplus. This is called as equity shareholder funds. This is called as equity shareholder funds. Okay, this is called as equity shareholder funds. Equity, reserves and surplus, and preference share capital. This is called as owners funds or proprietors funds. Yeah, this is owners funds. Okay, owners funds, or I can also call it as proprietors funds, or we can call it as equity also. Okay, equity, owners funds. Now, my owners funds and my long-term debts, I can put the capital, my money also, I can put the capital outside money also. So this is nothing called as total capital employed. So capital employed, now your own funds plus the outside funds, which is what is called as capital employed, or it is also called as net worth. Net worth na total assets minus outside liabilities. Outside the inventory liabilities except capital. So total assets minus outside liabilities is equal to net worth, or owners funds plus your outside capital. Okay, this is outside capital. This is outside capital. So both these are the capital employed. Okay. Now, if someone is asking you profitability ratios, so return on capital employed, someone is asking you. Give a return on capital employed, or return on net worth. Okay, or return on net worth. If someone is asking you, you have to write what is the earnings available for both. The earnings available for both is operating profit, correct? In the operating profit, the interest is also you're giving, and preference dividend and dividend is also you're giving. So you have to put EBIT divided by capital employed. That is what is the answer. If someone is asking you return on equity shareholder funds, if somebody is asking you return on equity shareholders, what is the earnings available to equity shareholders? It is earnings available to equity shareholders, which is nothing but PAT minus preference dividend divided by equity shareholder fund. This is nothing but equity share capital plus reserves and surplus. Correct. This is nothing but equity share capital plus reserves and surplus plus long-term debts. So all these are all as profitability ratio. So profitability ratio, you have to understand like that. The earnings that is available for the capital providers divided by the capital, okay, divided by their respective capital. That is what is the profitability ratios. So in the profitability ratios, the gross profit ratio, okay, a gross profit ratio, which is nothing but profit divided by sales. So gross profit divided by sales. Net profit ratio, this is nothing but net profit divided by sales. Operating profit ratio, this is nothing but operating profit divided by sales. Operating profit na EBIT, சரியா? Operating profit divided by sales. Okay, sir. So எனக்கு profitability ratios clarity வருது sir. Okay. இதே மாதிரி ஓகேவா, இதே மாதிரி liquidity ratios ஒன்று இருக்குது. ஓகேவா, liquidity ratios. Liquidity ratiosனா how liquid your firm is, which means is your firm is having enough amount to pay back the liabilities. இதுல short term and long term. Short term current நீ analyze பண்ற, long term non current நீ analyze பண்ற. ஓகேவா, so short term and long term. இதுல என்ன வரும், current ratio, which is nothing but current asset divided by current liabilities. Quick ratio, which is nothing but quick asset divided by current liabilities. Quick asset என்னது, current asset minus inventory minus bank, sorry, நான் minus வந்து நீ prepaid expenses பண்ணு. ஓகேவா, minus prepaid expenses. This is what is the quick asset. Quick asset inventory remove பண்ற, prepaid expenses remove பண்ற. So you will get quick assets. So one more test is asset test ratio. Okay, but asset test ratio is nothing but cash and bank balances divided by current liability. Okay, all these are short-term liquidity ratios. Long-term liquidity ratio is debt equity ratio. So debt equity ratio is debt divided by equity. Debt to total asset ratio. Okay, so debt divided by total assets. Okay, so debt to total liability. So debt divided by debt plus equity. So in the money, all this are long-term. Other main is debt equity ratio. So next is turnover ratios. Okay, very important, very important. Turnover ratios na enna sir? Turnover ratios na avanga enna solranga, for 1 rupee, okay, for 1 rupee of something, how much sales I'm making. For example, total asset turnover ratio. Okay, total asset turnover ratio. இதுல எப்பவுமே turnover வந்து மேல வரும். ஓகேவா, டர்ன்ஓவர் வந்து எப்பவுமே மேல வரும், டிவைடட் பை டோட்டல் அசெட்ஸ். ஸோ டர்ன்ஓவர்னா சேல்ஸ். ஓகேவா, டர்ன்ஓவர்னா சேல்ஸ். What is turnover? Turnover means sales divided by total. So how to interpret, for 1 rupee of asset that I'm investing, how much amount of sales that I'm able to generate? So that is the reason they will tell me in times. For example, I'm generating a sales of 10 lakh rupees by investing 2 lakh rupees in assets. So which means for every 1 rupee of asset invested, I'm able to generate 5 rupee of sales. So 1 rupee extra asset invest panna, 5 rupee extra na sales generate panna. That is what turnover ratios is talking about. Turnover ratios is talking about na 1 rupee investment na evlo sales generate panna. That is what they are talking. So 1 rupee invested in total assets, how much sales I'm generating? 5 times. So this is the answer. 5 times is the answer. The total asset turnover ratio. இதே மாதிரி fixed asset turnover ratio. Total asset na fixed asset plus current asset plus non current asset. அதே மாதிரி fixed asset turnover ratio. Fixed asset turnover ratio என்னது? Sales divided by fixed assets. Okay, sales divided by fixed assets. Okay, next, capital employed turnover ratio. Sir, capital employed turnover ratio என்னது? Sales divided by capital employed. So for every 1 rupee of capital invested, what is the amount of sales that I'm generating? Here, for every 1 rupee of fixed asset investment, what is the amount of sales that I'm generating? Here, for every 1 rupee of total assets invested, what is the amount of sales that I'm generating? So capital asset turnover ratio. Next, another sir, current asset turnover ratio. Abhina current assets, sorry, sales divided by current assets. Okay, sales divided by current asset turnover ratio. Next, என்ன சார் பண்ணலாம், working capital turnover ratio. அப்படின்னா for every 1 rupee invested in working capital, what is the sales that I'm generating? So sales divided by working capital. Working capital என்னது சார்? Current asset minus current liabilities. That is what is our working capital. Okay sir, working capital turnover ratio முடிஞ்சது சார். Next நம்ம என்ன பண்ணலாம், inventory turnover ratio. ஓகேவா, inventory turnover ratio. Inventory turnover ratio என்னது? Sales divided by inventory. So for every 1 rupee invested in inventory, what is the amount of sales that I'm generating? But here you have to put one point. In inventory, profit will not be there. Inventory is always carried at cost, correct? Inventory is always carried at cost. So here profit will not be there. And sales la profit இருக்கும். Sales la profit will be added. சார் அப்படின்னா இந்த சேல்ஸ் காஸ்ட்டை நம்ம கன்வெர்ட் பண்ணும். அதனாலதான் நீ என்ன பண்றேன்னா காஸ்ட் ஆஃப் குட்ஸ் சோல்ட் டிவைடட் பை இன்வென்ட்ரி பண்றேன். ஓகேவா, காஸ்ட் ஆஃப் குட்ஸ் சோல்ட் டிவைடட் பை இன்வென்ட்ரி பண்றேன். இந்த இன்வென்ட்ரினா க்ளோசிங் ஸ்டாக். சார் ஓப்பனிங் ஸ்டாக் எடுக்கணுமா, க்ளோசிங் ஸ்டாக் எடுக்கணுமா, இல்லைன்னா இன்வெஸ்ட்மெண்ட் இன்வென்ட்ரி எடுக்கணும். யூ ஹேவ் டு ரைட் இன்வென்ட்ரி இன்வெஸ்ட்மெண்ட். ஸோ இதுக்கு நீ என்ன பண்ண தெரியுமா, ஆவரேஜ் இன்வென்ட்ரின்னு எடுத்துக்கணும். So average inventory எடுக்கும்போது COGS divided by average inventory. Sir, COGS value கொடுக்கலன்னா sales side, ஓகேவா? So first preference is given to COGS. COGS value கொடுக்கலன்னா sales count. So inventory turnover ratio is COGS divided by average inventory instead of sales divided by inventory. ஏன்னா here profit is not included. So from here also you are removing the profit. Sir, அப்படின்னா நம்ம என்ன சார் பண்றோம்? Cost of goods sold is nothing but sales ல இருந்து gross profit remove பண்றேன். That is what is cost of goods sold. ஏன்னா inventoryல profit இல்ல, அதனால sales ல இருந்து you have to remove profit. So COGS is equal to sales minus gross profit. So inventory turnover ratio. Next sir, debtor turnover ratio. For every 1 rupee invested in debtor, what is the sales that I'm generating? Okay, well, so sales divided by average debtors. Average debtors. Sir, இங்க சேல்ஸ் நம்ம போடணுமா? இங்க சேல்ஸ் பண்ணும், காஸ்ட் போடக்கூடாது. ஏன்னா டெட்டாஸ்ல ப்ராஃபிட் இன்க்ளூடட். ஸோ அதனால சேல்ஸ்ல கூட ப்ராஃபிட் இன்க்ளூடட். ஓகேவா? நவ் சார், ஆவரேஜ் டெட்டாஸ் நம்ம போட்டோம். ஓகேவா? ஆவரேஜ் டெட்டாஸ் நம்ம போட்டோம். சேல்ஸ். ஆனா டெட்டாஸ் will be happening on cash sales or credit sales. Debtor will only be happening on credit sales. So credit sales divided by average debtors. ஏன்னா cash salesக்கு debtors வராது. So credit sales divided by average debtors is the debtors turnover ratio. Next is payables turnover ratio. Payables turnover ratio. So divided by first average payables போட்டுரு. ஆனா payables will not happen for sales. It will be happen for purchases. So இங்க வந்து credit purchases போட்டுரு. ஓகேவா? So debtor turnover ratio is equal to credit sales divided by average debtors. Payables turnover ratio is equal to credit purchases divided by average payables. Inventory turnover ratio is equal to cost divided by average inventory. அதே மாதிரி all the different turnover ratios நீ பார்க்கலாம். ஓகேவா? All the different turnover ratios நீ பார்த்துக்கலாம். Okay. இதே வந்து debtors collection period is nothing but 360 days. Suppose daysல இருந்தா 360 days போடு, monthsல இருந்தா 12 months போடு, divided by debtors turnover ratio. Okay, but divided by debtors turnover ratio. Same way the payment period. Okay, but the credit period. This is debtors collection period. This is the payment credit period. Okay, credit period for payment. It is again okay, but 360 days divided by 12 months or 12 months divided by payables turnover ratio. Okay, payables turnover ratio, debtors turnover ratio. Okay, suppose collection period னு கொடுத்திருப்பாங்கன்னா 360 days or 12 months divided by turnover ratio. அப்படின்னா என்ன அர்த்தம் சார்? My turnover ratio is 2 times the ratio. Okay, my turnover ratio is 2 times, which means for every 1 rupee I'm investing in debtors, I'm able to generate 2 times of my sales. Okay, 2 times of my sales. அப்படின்னா how much is my credit period now? So 12 months divided by 2 times பண்ணா 6 months is my credit period. Okay, 6 months is my credit period. அதனாலதான் every year 2 times I'm able to rotate my debtors. Are you all with me? Yeah, 2 times I'm able to rotate my debtors. 6 months is my credit period. Okay, இதே 5 times is my debtors turnover ratio. 12 divided by 5. Okay, 12 divided by 5, which is, so 12 divided by 5 பண்ணும்போது you will be getting 2.4. Okay, but 2.4 months. So that is how you have to analyze. So debtors turnover ratio na credit sales divided by average debtors. Payables turnover ratio na credit purchases divided by average payables. Okay, sir. So turnover ratios முடிஞ்சது, profitability ratios முடிஞ்சது, liquidity ratios முடிஞ்சது. Now we have one more which is important, coverage ratio. Okay, but coverage ratio. Coverage ratio na how much of my earnings I'm having to cover my fixed cost. That is what is called. So, okay, interest coverage ratio, which means how much earnings I'm having to cover my interest. So EBIT divided by interest. Okay, and EBIT is the earnings available for the debt shareholders. Okay, I mean debtors, debenture holders. So அதனால I have to write EBIT divided by interest. சரி சார், preference dividend coverage ratio-னா நீ என்ன போடணும்? PAT போடணும். ஏன்னா PAT-ல இருந்து தான் நீ preference dividend pay பண்ற. See, PAT ல இருந்து தான் நீ preference dividend pay பண்ற. ஓகேவா? PAT ல இருந்து you are paying preference dividend. So it will be PAT divided by preference dividend. இன்ட்ரெஸ்ட் எப்படி பேமெண்ட் பண்ற? EBIT ல இருந்து நீ இன்ட்ரெஸ்ட் பேமெண்ட் பண்ற. ஓகேவா? So that is the reason interest coverage ratio EBIT divided by interest. Preference dividend coverage ratio is PAT divided by preference dividend. இதுனா என்ன அர்த்தம் சார்? Suppose I'm having 10 lakh rupees earnings and 1 lakh rupees interest na, I'm having 10 times extra money to pay back my interest. That is what is, which means I'm covering 10 times of my interest as my earnings. So that is what is interest coverage ratio. So which means ஒரு 10 times extra amount என்கிட்ட இருக்குது. Okay, as an earnings. That is what is coverage ratio. So I'm covering my interest 10 times. இங்க I'm covering my preference dividend how many times? So PAT divided by preference dividend. இன்னும் வந்து debt service coverage ratio, ஓகேவா, very important. Debt service coverage ratio, it is called as DSCR, ஓகேவா, debt service coverage ratio, DSCR. சார் டெட் சர்வீஸ் கவரேஜ் ரேஷியோல நம்ம எப்படி சார் கால்குலேட் பண்றது? சார் இங்க நீ என்ன பேமெண்ட் பண்ற, இங்க நீ இன்ட்ரெஸ்ட் பேமெண்ட் பண்ற, ஓகேவா, இங்க நீ ப்ரிஃபரன்ஸ் டிவிடெண்ட் பேமெண்ட் பண்ற. ஆனா ஆக்சுவலா நம்ம லோன் வாங்குறோம்னா நம்ம வெறும் இன்ட்ரெஸ்ட் அமௌண்ட் பே பண்ணல, நம்ம இன்ஸ்டால்மெண்ட் அமௌண்ட்டும் பே பண்றோம். We are also paying interest and we are also paying some principal repayment also. So every year my outflow is not interest, my outflow is interest plus my installment, ஓகேவா. So இங்க நீ என்ன பண்ணு, interest plus installment, ஓகேவா, interest plus installment. So how much of my earnings I'm having to pay back my interest plus my installment amount, that is what is called as debt service coverage ratio. So இந்த மூணு important coverage ratio பத்தி. So interest coverage ratio EBIT divided by interest, preference dividend coverage ratio PAT divided by preference dividend, debt service coverage ratio EBIT divided by interest plus installment. Okay, so that is what you know. So now profitability ratios also, you know, return on capital employed, return on net worth, okay, return on equity shareholders funds, everything you know. அதே மாதிரி turnover ratios you know, and liquidity ratios also you know, short term liquidity and long term liquidity ratios. ஸோ ரேஷியோஸை பார்க்கும்போது அவ்வளோ போதும், ஓகேவா, அவ்வளோ ரேஷியோஸ் இருந்தால் நீ ப்ராப்ளம் சால்வ் பண்ணலாம். ஸோ இப்போ நான் என்ன பண்ணேன்னா ஒரு சின்ன இன்னொரு ப்ராப்ளம் மட்டும் சால்வ் பண்ணுறேன், ஸோ தட் நமக்கு கிளாரிட்டி. This is ratios. See, ratios like you are having, in ratios you will be having, you know, two different types of problems. One will be income statement and balance sheet will be given and they will be asking you to find ratios. அதான் 12th standardல படிச்சிருக்கேன் கரெக்டா. ஸோ அவங்க இன்கம் ஸ்டேட் பேலன்ஸ் ஷீட் கொடுத்துருவாங்க, they will be asking you to find out ratio. Second will be they will be giving you ratios and some informations and they will be asking you to construct a balance sheet, okay, or income statement. This is what is the second type of problem. Usually this type of problem are asked in the examination, okay. This type of problem are usually not asked, but it can be asking. Now here income statement is given, balance sheet is given, and they are asking you to find out these much ratios for 1920. So inventory turnover ratio, the formula another, COGS divided by average inventory, okay, COGS divided by average inventory. So அப்படியே இங்க COGS கண்டுபிடி, okay, what is my COGS? So COGS for 1920, you know, you are finding out for 1920. So cost of goods sold is 21,100. So நீ என்ன பண்ணு, 21,100 is your COGS. Average inventory, no, opening inventory plus closing inventory divided by 2. So what is your opening inventory? 2,500. What is the closing inventory? 2,000. So 4,500 divided by 2 பண்ணு, okay. So 4,500 divided by 2 பண்ணா உங்களுக்கு எவ்வளவு வருது? 2,250 வருது. So 2,250. So 21,100 divided by 2,250 is equal to 9.38 times. So calculation la paatha 9.38 times onu varum, okay, answer. இங்க அதே தான் வருது, ஓகேவா, 9.4, அதான் 9.38 times. So இந்த மாதிரி you have to find out, ஓகேவா, இந்த மாதிரி you have to find out. இது next financial leverage, return on capital employed, ஓகேவா. Yeah, one more thing, return on capital employed, ஓகேவா. Return on capital employed நான் என்ன ஃபார்முலா சொல்லி கொடுத்துருக்கேன், EBIT, which is the earnings available for the capital employed divided by capital employed. இங்க ப்ரீ டாக்ஸ் கொடுத்துருவாங்க, போஸ்ட் டாக்ஸ் கொடுத்துருவாங்க, ஓகேவா, ப்ரீ டாக்ஸ் அண்ட் போஸ்ட் டாக்ஸ். ப்ரீ டாக்ஸ்னா EBIT divided by capital employed, போஸ்ட் டாக்ஸ்னா EBIT ல இருந்து டாக்ஸ் மட்டும் மைனஸ் பண்ணிடு, ஓகேவா, divided by capital employed. So that is what is the thing, ஓகேவா. ஸோ இங்கே ROC பார்க்கும்போது அவங்க போஸ்ட் டாக்ஸ் தான் கேட்டிருப்பாங்க, ஓகேவா. ஸோ போஸ்ட் டாக்ஸ் கொடுக்கலையா, நீ ரெண்டுமே கால்குலேட் பண்ணலாம், ஏன்னா டாக்ஸ் கொடுத்துருவாங்க, நீ போஸ்ட் டாக்ஸ் கூட நீ பண்ணலாம், சரியா. யூஸ்வலா ப்ரீ டாக்ஸ் பண்ணு, கொடுத்தீங்கன்னா போஸ்ட் டாக்ஸ் பண்ணு, ஆனா இங்க அவங்க போஸ்ட் டாக்ஸ் பண்ணிருக்காங்க. So that is how you have to solve the problems. ஆனா நான் இன்னொரு ப்ராப்ளம் பண்றேன். Okay, let me do question number 1. Okay, let me do question number 1. Now, question number 1. And I will also be teaching the approach. The approach for ratio problem is that first approach. Okay, first எப்படி இந்த approach பண்றது சார்? First, find where absolute numbers are given. Okay, you have to find where absolute numbers are given. Absolute numbers are direct number கொடுத்துருவாங்க. ஓகேவா? Now here see direct எங்க நம்பர் கொடுத்துருவாங்க. Okay, gross profit direct number கொடுத்திருக்காங்க. Reserves and surplus direct number கொடுத்திருக்காங்க. ஓகேவா? So wherever direct numbers are given, அது மேல நீ first focus பண்ணு. ஓகேவா? Second, using these absolute numbers, you check where this number can be used in ratios. Okay, where this number can be used in ratios. Where this can be used in ratios. Angle in the values find out, then find values. And again, that value is where you can use the next ratios find out. One by one, values and the approach and solve. So first find where absolute value. So if you directly read the problem, you will not get anything. First see where values are given and where you can use that values. Okay, so gross profit is given. Where you can use this formula for gross profit. Fixed asset turnover ratio can use panna. Fixed asset turnover ratio na sales divided by fixed asset. In gross profit. Capital turnover ratio na, okay, sales divided by capital. Inventory turnover ratio na COGS divided by average inventory. Okay, COGS divided by average inventory. Receivable turnover ratio na sales divided by average receivables. Payables turnover ratio na purchases divided by average payables. Gross profit ratio na gross profit divided by sales. Now you can use the gross profit here. So apply find out one to first sales kandupidichidum. Now once you know the sales, the COGS kandupidichidala. Once you know the COGS, ella values me kandupidichidala, correct? Ella values me kandupidichidala. Fixed asset kandupidichidala, capital kandupidichidala, inventory kandupidichidala, receivables kandupidichidala. Are you all with me? Seri, okay sir. Panni kaattuga sir. Okay. First, gross profit ratio is equal to 25%. It is nothing but gross profit divided by sales. Okay, is equal to 25%. What is my gross profit? 8 lakh rupees. Okay, so gross profit is equal to 8 lakh rupees divided by sales is equal to 25%. Therefore, sales is equal to 8 lakhs. 8 lakhs divided by 25%. So I am getting my sales is equal to 8 lakhs divided by 25%. So 32 lakhs is my sales. Okay, but 32 lakh is my sales. Now COGS is nothing but sales minus gross profit. So what is my sales? 32 lakh. What is my gross profit? My gross profit is 8 lakhs. Okay, gross profit is 8 lakh. So 32 lakh minus 8 lakh, 24 lakh. So COGS is equal to 24 lakhs. Okay, so COGS is equal to 24 lakhs. Sales COGS. Now using the sales, fixed asset okay, fixed asset turnover ratio. Fixed asset turnover ratio is equal to 8 times. Is equal to 8 times. Apina enna artham sir? Sales divided by fixed asset is equal to 8. I know my sales is equal to 32 lakhs. Okay, so fixed asset is equal to 32 lakhs divided by 8. So therefore, fixed asset is equal to 32 lakhs divided by 8. 4 lakhs. Okay, so my fixed asset is 4 lakh rupees. My fixed asset is 4 lakh rupees. Again, okay, capital employed to long term debt illa. So capital equity share capital plus reserves and surplus. Okay, why na long term debt illa? This is capital employed. Capital employed is equal to equity share capital plus reserves and surplus plus long term debts. If I'm having no long term debt, capital turnover ratio is equal to equity share capital plus reserves and surplus. Okay, sir. So my fixed asset is equal to 4 lakh rupees. Adhe mari capital turnover ratio is equal to 2 times. Okay, so what is my capital? My capital is equal to 2 times 32 lakh divided by 2. Okay, 32 lakh divided by 2. Okay, 32 lakh 8. 32 divided by 2. 32 divided by 2 panna 16 lakhs. Okay, so 16 lakh rupees is my capital. And the 16 lakh capital, 2 lakh is actually reserves and surplus. Okay, so 2 lakh is reserves and surplus. If 2 lakh is reserves and surplus, what is my equity share capital? 14 lakh rupees is my equity share capital. Okay, 14 lakh rupees is my equity share capital. Okay, sir. Okay. Next is inventory turnover ratio. Adhe mari, average inventory. When you have to take average inventory, if any information about opening inventory is given, then you have to put average inventory. Closing stock is 20,000 plus opening stock. So closing stock is equal to opening stock plus 20,000. So ending inventory is 20,000 above beginning inventory, which means closing stock is opening stock plus 20,000 rupees. So average inventory is equal to closing stock plus opening stock divided by 2. Okay. So now inventory turnover ratio. Okay, inventory turnover ratio. So what I want to do, I want to find out my average inventory. So average inventory is equal to, okay, my cost divided by inventory turnover ratio, that 8 times. So what is my cost? My cost is 24 lakhs. So my cost is 24 lakhs. 24 lakhs divided by 8 போடணும். Okay, so divided by 8 போட்டா, so 24 lakhs divided by 8 போட்டா எனக்கு எவ்வளவு வரும்? 3 lakh rupees வருது. Okay, so 3 lakh rupees is my average inventory. ஆனா எனக்கு closing inventory வேணும். எனக்கு closing inventory வேணும் because I want to find out my assets and liabilities. So like asset na closing inventory வேணும். So this is my average inventory. So you know that closing inventory is equal to opening inventory plus 20,000. So first opening stock plus closing stock divided by 2 is equal to 3 lakhs. Okay, opening stock plus closing stock. So which means opening stock plus closing stock is equal to 6 lakh rupees. Now closing stock is equal to opening stock plus 20,000. Okay, so closing stock is equal to opening stock plus 20,000. So opening stock plus 20,000 is equal to 6 lakh rupees. Abdina 2 into opening stock is equal to 6 lakh minus 20,000, 5 lakh 80,000 rupees. Abdina opening stock is equal to 5 lakh 80,000 rupees divided by 2. It is 2 lakh 90,000 rupees. Sir, my opening stock is 2 lakh 90,000 rupees. So closing stock is opening stock plus 20,000. So opening stock 2 lakh 90,000 rupees. Closing stock 2 lakh 90,000 rupees plus 20,000 rupees. So I am having my closing stock is equal to 3 lakh 10,000 rupees. Okay, so the 2 lakh 90 plus 310 divided by 2, now the average 3 lakh. Okay, so now I found out my closing stock is 3 lakh 10,000 rupees. Adhe mari receivable turnover ratio 4 times. Okay, receivable turnover ratio. So other than that, you have to find out receivables. Receivables na other sales divided by, so what is my sales? 32 lakhs divided by what is the receivables turnover ratio? 4 times. So 32 lakh divided by 4, it is 8 lakh rupees. So I am also having receivables of 8 lakh rupees. Now payables turnover ratio. So payables can purchase தேவைப்படும் sir. ஒரு நிமிஷம், it is stuck. Just 1 minute. Okay. இப்போ நான் என்ன பண்ணணும் சார், எனக்கு பேயபிள்ஸ்க்கு எனக்கு பர்ச்சேஸ் தேவைப்படும் சார். பர்ச்சேஸ் இல்லை சார். See, you all know that opening stock plus purchases minus closing stock is equal to cost of goods sold. Correct? Correct. Opening stock plus purchases minus closing stock is equal to cost of goods sold. What is your opening stock? You know that your opening stock is 2 lakh 90,000. Correct? So 2 lakh 90,000. Purchases எனக்கு தெரியாது. Closing stock 3 lakh 10,000. Cost of goods sold எனக்கு தெரியும். It is 24 lakhs. அப்படின்னா purchases ஈஸியா கண்டுபிடிச்சிடலாம். 24 lakh plus 310 minus 220. Correct answer. 24 lakh plus 3 lakh 10,000 minus 2 lakh 90,000. So you are having a purchases of 24 lakh 20,000. You are having a purchases of 24 lakh 20,000. அப்படின்னா payables is equal to 24 lakh 20,000. Other purchases divided by the number of times. It is 6 times. It is stuck. Just 1 minute. Okay, so divided by 6 times. So what is my purchases? 4,03,333 is my purchases. Okay, 4,03,333 is my purchases. If அப்படியே நான் balance sheet போடணும். Okay, அப்படியே நான் balance sheet போடணும். Equity share capital, reserves and surplus. Okay, ஏன்னா owners funds ரெண்டு மட்டும் தான் இருக்குது. Equity share capital, reserves and surplus. அதே மாதிரி here I am having fixed assets and then current assets என்னென்ன இருக்குது? Receivables. Okay, inventory receivables. So equity share capital is 14 lakh and 2 lakhs. Okay, 14 lakhs and 2 lakhs. So 14 lakh and 2 lakh rupees. Key and the payables. Okay, key and the payables. What is my payables? 4,03,333. 4,03,333. இங்க பாரு owners வரும், payables வரும், வேற ஒண்ணுமே current liability total liability. My total liability is 16 plus 4, 20 lakh 3,333. Okay, sir. What is my fixed assets? 4 lakh is my fixed asset. Inventory is 310. Okay, so 4 lakh. The 10. Receivables is again 4 lakh. 8 lakhs. So receivables is 8 lakhs. Cash கூட வரலாம். Okay, but cash you can write it as cash or other assets are near there. Okay, so total liability is equal to total assets. So 20 lakh 3,333. So balancing figure the cash போடுறேன். Okay, so 20 lakh ஒரே நிமிஷம் 20 lakh 3,333 minus 8 lakhs minus 3 lakh 10,000 minus 4 lakhs. இங்க எவ்வளவு வருது? 4 lakh 93,333. This is what is the answer. Okay, this is what is the answer. அப்படியே செக் பண்ண ஆன்சர். Once you check this answer, இங்க பாரு ஷேர் கேபிட்டல் 10 ரிசர்வ்ஸ் அண்ட் சர்ப்ளஸ் 12 போட்டிருக்காங்க. ஏன் சார்? ஆனா நமக்கு 14 and 2 வருது சார். கீழே நோட் படி அவங்க காஸ்ட் ஆஃப் சேல்ஸ் which means காஸ்ட் ஆஃப் கூட்ஸ் சோல்ஸ்ல இருந்து எடுத்திருக்காங்க. ஓகேவா? அவங்க என்ன எடுத்திருக்காங்கன்னா இந்த ரேஷியோ fixed asset turnover ratio, inventory turnover ratio and capital turnover ratio cost of goods sold எடுத்திருக்காங்க. ஆனா நமக்கு இன்வென்டரி மட்டும்தான் நமக்கு காஸ்ட் ஆஃப் கூட்ஸ் சொல்ல பண்ணுவோம். இன்வென்டரி மட்டும்தான் நமக்கு காஸ்ட் ஆஃப் கூட்ஸ் சொல்ல பண்ணுவோம். ஆனா கேபிட்டல் அண்ட் ஃபிக்ஸட் அசெட் நம்ம சேல்ஸ் கொடுத்திருந்தாங்கன்னா சேல்ஸ் தான் ஃபர்ஸ்ட் பண்ணுவோம். ஆனா அவங்க நோட் போட்டு அப்படி பண்ணிருக்காங்க. ஓகேவா? ரிவிஷன் டெஸ்ட் பேப்பர்ல. ஆனா நீ காஸ்ட் ஆஃப் கூட்ஸ் சொல்ல பண்ணா அது கரெக்ட் தான். ஓகேவா? கீழே ஒரு நோட் போட்டு தட் இட் இஸ் கால்குலேட்டட் ஆன் சேல்ஸ். ஸோ இன்வென்டரி உனக்கு கரெக்டா வந்துடும். ஓகேவா? ஸோ இன்வென்டரி 3,10,000 கரெக்டா வந்துடும். ஆனா இது அவங்களுக்கு கரெக்டா வராது. ஓகேவா? ஸோ 4,03,000 உனக்கு கரெக்டா வரும். ஆனா இது கரெக்டா வராது. ஓகேவா? ஸோ தட் இஸ் த ரீசன் நமக்கு 20 lakh வருது, அவங்களுக்கு 16 lakh வருது பிகாஸ் தேவ் கால்குலேட்டிங் ஆன் காஸ்ட் ஆஃப் கூட்ஸ் சோல்ட். ஸோ அவர் ஆன்சர் இஸ் ஆல்சோ கரெக்ட். திஸ் ஆன்சர் இஸ் நாட் சோ கரெக்ட் ஐ வுட் சே. ஓகேவா? ஆனா அவங்க நோட் கொடுத்திருக்காங்க. ஸோ இட் இஸ் கரெக்ட். ஓகே, அவங்க நோட் கொடுத்திருக்காங்க. ஸோ எப்பவுமே ஒரு சேஃபர் சைட்ல இருக்கும்போது யூ ஆல்வேஸ் ரைட் அ நோட் that the above calculations are calculated on sales. Okay, on sales. Actually salesல தான் பண்ணனும். If sales is not there, அப்பதான் cost of goods சொல்ல பண்ணனும். ஆனா அவங்க டைரக்டா cost of goods சொல்ல பண்ணிருக்காங்க. So fixed asset you are doing on sales, inventory you are doing on COGS, capital you are doing on sales. Inventory na COGS ல தான் பண்ணனும். ஓகேவா? no other choice. நோட் இருந்தா நோட் இல்ல, இன்வென்டரி காக்ஸ்ல தான் பண்ணனும். இது ரெண்டு அவங்க சேல்ஸ்ல பண்ணிட்டு நோட் கொடுத்துட்டாங்க, நீ காக்ஸ்ல பண்ணிடு. ஓகேவா? ஆர் சேல்ஸ்ல பண்ணிட்டு நோட்ஸ் கொடுக்கணும். நோட் இஸ் வாட் இஸ் மோர் இம்பார்ட்டன்ட். ஓகே, both the answers are correct. So our answer is also correct. அப்படியே பாரு, payables 4,03,333, fixed asset 4 lakh. ஓகே, இன்வென்டரி வந்து 3,10,000, இன்வென்டரி 3,10,000. ரிசீவபிள்ஸ், ஏன்னா நம்ம ரிசீவபிள்ஸ் வந்து நம்ம சேல்ஸ்ல பண்ணிருக்கோம், அதனால நமக்கு 8 lakh வருது, அவங்களுக்கு 8 lakhs வருது, அவங்களுக்கும் 8 lakh வருது, ஏன்னா அவங்களும் சேல்ஸ்ல பண்ணிருக்காங்க. ஆனா அவங்க ஃபிக்ஸட் அசெட் காஸ்ட்ல பண்ணிருக்காங்க. ஓகேவா? அண்ட் கேபிட்டல் அவங்க காஸ்ட்ல பண்ணிருக்காங்க. தட் இஸ் வாட் இஸ் தி டிஃபரன்ஸ். ஸோ அதனால ஃபிக்ஸட் அசெட் அண்ட் கேபிட்டலோட வேல்யூ மட்டும் சேஞ்ச் ஆகும். இந்த வேல்யூ சேஞ்ச் ஆகுதுனால இந்த வேல்யூ சேஞ்ச் ஆகும். தட் இஸ் வாட் இஸ் த டிஃபரன்ஸ். No other difference is there. So that is how you have to do ratios problem. Ratios problem, my only suggestion is that you have to practice number of problems. Okay, appo nee ratios வந்து handle பண்ண முடியும். Are you all with me? Okay, so comment box la yes மட்டும் போட்ரு. So I'll be getting to know. Okay, so with this we also completed ratio analysis. Okay, ratio analysis நம்ம complete பண்ணிட்டோம். Okay, see, we are coming a long way in the revision. Okay, we are coming a long way, and slow by slow we are tackling all the chapters. இப்போ நீ பாரு, இதெல்லாம் நம்ம இன்ட்ரோல நம்ம நேத்து முடிச்சோம். கரெக்டா? இன்ட்ரோ நம்ம முடிச்சிட்டோம், லீவரேஜஸ் நேத்து முடிச்சிட்டோம், காஸ்ட் ஆஃப் கேபிட்டல் நேத்து முடிச்சிட்டோம். சரியா? இன்னைக்கு நம்ம என்ன பண்ணுவோம்? இன்வென்டரி 30% பெண்டிங். கரெக்டா? அதுவும் நம்ம முடிச்சிட்டோம். அதுல இஏசி நம்ம பண்ணோம், அண்ட் எஸ்டிமேஷன் ஆஃப் ஒர்க்கிங் கேபிட்டல், எஸ்டிமேஷன் ஆஃப் ஒர்க்கிங் கேபிட்டல் அட்ஜஸ்ட்மெண்ட் சொல்லி கொடுத்துருக்கேன். அண்ட் தென் எஸ்டிமேஷன் ஆஃப் கேஷ் ஃப்ளோ எப்படி பண்ணணும், ஸ்கிராப் வேல்யூ அட்ஜஸ்ட்மெண்ட் எப்படி பண்ணணும், அண்ட் கேஷ் ஃப்ளோ எப்படி அரைவ் பண்ணணும், யூ ஹேவ் டு ஆட். அதெல்லாம் நம்ம சொல்லி கொடுத்தோம். கரெக்டா? நேற்று நம்ம டெக்னிக்ஸ் டிஸ்கஸ் பண்ணோம், இங்க நம்ம என்பிவி ப்ராப்ளம் எப்படி சால்வ் பண்ண டிஸ்கஸ் பண்ணோம். ஸோ இன்வெஸ்ட்மெண்ட் டெசிஷன் முடிச்சிட்டோம், capital structure decision நம்ம முடிச்சிட்டோம். ஓகேவா? and ratio analysis நம்ம முடிச்சிட்டோம். So we only have now 2 chapters pending, which is dividend decisions and working capital management. Okay, and our agenda is to complete these 2 chapters tomorrow. Dividend decisions and working capital management. These 2 chapters we are going to cover tomorrow. Okay, so today we discuss பண்ணிட்டோம். See, we have come a long way. Types of financing, I would want you to read it on your own. ஏன்னா அதுல நான் ஏதோ evaluate பண்ண முடியாது. It is a theory chapter, like story you read it, and அதுல சில importance மட்டும் நான் சொல்றேன். அதே மாதிரி debt securitization, all these are very important. Okay, venture capitalist, all these are some important. அது மட்டும் நீ படிச்சு. Okay, so all these chapters are completed. 2 chapters are only remaining: dividend decisions and working capital. And the dividend decision is a very easy chapter. 30 minutes and a dividend decision முடிச்சிடலாம். Okay, for 30 minutes we can complete dividend decision. Working capital management கொஞ்சம் நம்பி நான் உனக்கு வந்து நாளைக்கு ப்ராப்பரா எக்ஸ்பிளைன் பண்றேன். how to do working capital management சூப்பரா நம்ம டிஸ்கஸ் பண்ணலாம். ஓகேவா? So 2 chapters are alone remaining. That is our agenda for tomorrow's class. So which means நம்ம ஒரு 80% of our syllabus is completed. 20% of the syllabus will complete it tomorrow. Okay, so let me know in the comment box how you are feeling after this revision session. Okay, only then I will get to know that okay, you guys are enjoying the session or not, because this should not be a one time or one side interaction. I want an interaction from your side also. So people who are seeing it recording, write in the comment box. I will be checking the comment boxes also, and I will be replying also. And then people who are seeing me live, you write it in the live box that how live chat box, like how you are feeling after this revision, and tell me what is something that you want more. Okay, so that we can plan that also. End of the day, what I want is that you are also satisfied, and end of the day I should also be satisfied. Okay, so I'm just waiting for 2 minutes. I want something from the comment section, like how you're feeling after the revision session, and what is it something that you want. Or feedback mari kettirukken. So write something in the comment box. Sorry, okay. Sorry, theory chapter tips I'll be giving in the last. Okay, so fine. So this was it for today's class. So see you all tomorrow. Okay, tomorrow we'll be covering these 2 chapters, and end of the day I'll be giving you some of the important tips and tricks, so that will be helpful for you to enhance your marks also in financial management. And so the important what like what are the things where you should be focusing on. So yeah, so this was it for today. Thank you very much. See you all tomorrow. Okay, so thank you very much, and see you all tomorrow in the session. So tomorrow we will be discussing the other 2 chapters that is remaining. One is the dividend decision chapter, and the second one is the working capital management. Okay, working capital management. So these 2 chapters we will be completing it. Okay, so thank you very much. Thank you.